to stand in there and say, I'm bullish, because, like, don't get me wrong, I'm not bullish because if I were to be bullish on the stock market, it's not because I think that everything's great. It's just that I understand the dynamics, the cash flow, like the situation, the flow of funds situation that might cause the stock market to go up. But what the hard trade is to go up and say, yes, I know the stock market's overvalued, but I think it can keep rising. And it's difficult, but it's what's obvious is often wrong. And in fact, more and more, I found that when all the hedge funds go one way, like when you go and you start looking at the commitment of traders reports, and they're all getting bearish on the euro, or they're getting bullish on gold, or bearish on that. In this day and age of limited alpha, it's like the worst thing you can do is to go along with their trades. It's hazardous to your financial health. Like you almost have to. They have almost become the dumb money that you need to fade.
What are these commitment of trades reports?
The futures exchange is always they classify different users in different ways. So a farmer would be a hedger. So like if a farmer goes out and sells wheat, he's considered a hedger. If I go buy wheat, I'm considered a speculator. So they kind of, they classify the traders in different ways, and then they actually provide the data every Friday at 3:00, and you can have a look and see which way the speculators are positioned in every futures contract. So it's a way to measure sentiment, and you can get a good idea. And there's other things, like I know some of the foreign exchange firms will also offer retail sentiment. Like they'll actually tell you what their clients are leaning. Like they'll say the retail is long the pound, short the euro, long the yen. And so there's different ways to measure sentiments. It's just that the CFTC COT report is often one of the more popular ones.
Okay, cool. Now let's speak a bit about, I think it was around about 2000 when you went out on your own. So you went out trading. I think there was also you and a buddy of yours who you kind of teamed up in some ways and were just trading your own book. How did you guys go doing that? And what were some of the big differences you noticed from previously trading on an institutional desk to now trading your own book? Like I presume there were some challenges that came along with this.
Right. So let's just back up a little bit, because when I first started at RBC Dominion Securities, I was purely kind of an agency trader, meaning that I executed clients on orders on behalf of clients. Gradually, I kind of did more things where I would trade proprietary, mean trading on behalf of the bank. Kind of within a couple of years, I had kind of transitioned from all the way from an agency trader to a full-time, what they like call a prop trader, proprietary trader, where I was basically just executing for the bank. So I would basically do index arbitrage. I would do all the liability baskets in terms of when they came for, all sorts of different, clients wanted to execute big, huge baskets of stocks. I would do the rebalances for when the ETFs and also the indices went through changes. And then the other thing was that RBC DS was a very entrepreneurial shop, and they didn't stop you from doing anything. If you thought you could make some money, they let you kind of run with it. And so my experience with the computerized trading, had evolved, and bit by bit I started to do more different things. Instead of just executing programs, manually, I started to figure out how to auto trade them, and then from there we started to figure out how to do arbitrage between exchanges. So we were basically one of the first to do the arbitrage between the U.S. and Canadian exchanges. So like Research in Motion was a big stock, BlackBerry. It was listed in both exchanges. We would sit there and have the computer automatically buy on one market and sell on the other market, and this ended up being just kind of in the height of the dot-com bubble, a terrific business. And I kind of laugh because when I was writing the program and we were sitting there, one of my bosses came to me and he said, "What are you doing?" And I said, "Well, I'm writing this program to do interlisted arbitrage. And he said to me, why are you doing that? I already got 8 guys doing that. And they used to sit there on the phone all day doing it. Well, by the end, I think that those 8 guys were doing something different, because the machines kind of put them out of business in terms of the interlisted arbitrage. So it was a great place, because I was able to do a lot of different things and learn a lot of trade a lot of different products and offered a lot of opportunities. And then in 2000, I had my first child, and she was born with a heart defect, and I kind of she was fine and it was corrected at birth, but I kind of had one of those kind of life-changing moments. Like sometimes people have a near-death experience and it changes them, and my boss says, you were never the same after your child was born. And I said, yeah, you're right. And I kind of had an idea about what was important in life, and I decided that I didn't want to work for the bank anymore. So I quit, and I quit kind of on our best quarter ever, and I promised myself I was going to be like Michael Jordan and hopefully leave after sinking the 3-point basket. So I quit, and I wasn't sure what I was going to do for myself. I kind of knew I didn't want to work at the bank anymore, because it had become more bureaucratic as the years had gone by. And I kind of toyed with the idea of going and working for a hedge fund. And then I kind of decided that, I'm going to give trading on my own a whirl. And if it doesn't work after a year and I go back for work for a hedge fund, nobody's gonna remember that I kind of traded for myself for a year. But if I go work for a hedge fund and then quit in a year because I really don't want to do that, everyone's going to remember me as the bozo who quit 2 jobs kind of within a space of a year. So that was in 2000. So I quit, and then one of the fellows that I used to work with quit after me, and I kind of always said, hopefully I won't have to get a job, and I've been lucky enough to not have to get a job since then. And in terms of your question about how things changed, well, I could tell you I missed the trading desk. There's no doubt about it. Like the camaraderie of sitting on a desk with all the guys and gals, but was a lot of fun. And but the thing that I missed most was towards my end at RBC DS, I was trading fairly big size. So guys would, phone me up and say, we're going up on a print of $1 million or something. You want to buy some? And I'd buy like $250,000 or something. And then when I was trading for myself, guys used to phone me up out of just kind of courtesy and say, we're going up on a print of $1 million. Do you want to buy any? And I said, well, I'll buy 10, but I understand if you don't want to write the ticket, because when I'm buying 10, I'm just kind of more of an annoyance than actually putting up, making a price. So I missed the kind of trading institutional size, because when becoming a pro trader for yourself, you have to all of a sudden take off a lot of zeros when you're trading.
So were there any other challenges during that time? Like, I guess, obviously, like you mentioned there, you're trading much smaller size. I presume that kind of forced you in some ways to maybe trade different types of strategies as well.
Sure. Well, you're absolutely correct. We could no longer use the bank's balance sheet. So we had to change. Some of those capital intensive businesses completely disappeared. Having said that, things like interlisted ARB were still available to me. And although the margins were going down, I was still be able to compete. Eventually those completely disappeared, but for the first kind of 5 to 10 years, it was fine. And we could make some money doing that. The other thing, though, that we did find is that the banks were more like I mentioned the fact they became more bureaucratic. They became kind of not as nimble. And when a trade popped up, they would eventually get to it. But it took a while for them. They had to go ask somebody for permission to trade it, or, they had to write a program and they had to go get someone to allocate resources for it. So for us, we were kind of much more nimble and we could just kind of whip something up. So if I saw an opportunity, oftentimes I might have a week or 2 of trading it ahead of them where it was good money before they would come and drive it to zero. So yeah, trading smaller had its disadvantages, but it also had its advantages. So the other thing about trading smaller is I kind of laugh because you should. There's kind of 2 opportunities, I think, when you're a small time trader. One is when a trade is so big that everybody gets full, and it doesn't matter because they basically it can't handle the size. Like I remember there was a risk arb that was coming out of the index, and we had to buy some for the there was the ETF was selling it to us because we had to guarantee the closing prices, and back then there was no MOC, so we were on the hook for guaranteeing it. And I remember we had to buy it, and I was looking at this risk arb, and I was like, why is this thing trading so fat? And I remember getting on the phone with a risk arb guy from New York and saying, what's going on here? Like, I see you bought that last 100, and I think it was a Masco. I go, I see you bought that last 100 a Masco from us, but like this should be trading tighter. And he goes, I completely agree. The thing is, I'm full, and I got to back off. So the thing was, it was a big enough stock that it actually filled up even the risk arbitrage guys. So in those cases, that's when a little guy is at the same kind of, has the same advantages as a big guy. And he can go do the trade just as easily. The other one is when something's very small, that same risk arb guy that I spoke to in New York wouldn't bother with a company that's, 100 million because he can't buy more than 10%. It's 10 million, and he's just not going to bother. So for a little investor, so we found that oftentimes there was great opportunities in the stuff that the big guys didn't care about. So we kind of went for the both ends, the really big stuff that was too big for so big that it kind of overwhelmed the market, and then the really small stuff. You should try to always find your niche, right? Like you got to kind of know, the line about if you don't know at the Patsy at the poker table, it's you. You got to kind of understand you got to understand your niche, and you got to understand where you kind of fit in it. And I'll tell you one thing, I always laughed, and people, so I had a lot of institutional contacts, and they said, do you want me to give you a call with product? And I always said, don't bother, because I know that if you give me a call on product, you're going to have already called all the really big clients, and I'm basically only going to get the dregs. So what's the point of me getting a call? So I very quickly realized there was no point in getting calls.
Now, one of the interesting things you did when you went out on your own is you started trading, and correct me if I'm wrong here or I'm slightly off on the timeline, but when you went out trading independently, you began trading a lot of different things. So you weren't specializing in any one thing, or you might specialize in something for a while, but then you would move on to something else. Can you just tell us a little bit about, I guess, how you operated or still operate to this day?
For sure. So I don't specialize in one thing, and I have a wide variety of interests. One day, I love banging around S&Ps, and at the same time I'll go look at a convertible bond, or I'll look at a risk arb deal, or at one point we were mining Bitcoins way back when they were the first round. So we've done a wide variety of different things, and that's kind of one of our strengths is, again, the ability to not be put in a box. And I speak to some of my friends at the hedge funds, and I'm kind of always amazed at how much how restricted they are about what they're allowed to trade. So if I think there's an opportunity shorting boons, I go and I can short boons. If they do, they have to go ask for permission for it, and it might not even be in their mandate, so they might not even be allowed to do it. So whenever someone says, well, how do you make your money? And I always say, well, I'm not really sure, because I'm not sure what hopefully I'm going to figure out. And the market's a tough game, so it's not like I figure it out every time. But a couple of years ago, the oil bonds got really cheap. They got kind of, when oil got hammered, I started picking up all those bonds, and so I started learning as much as I could about those and trading those back and forth, and met some credit traders and started talking about individual issues and understanding all the different things, and then we got the rally, and now there's just not as much action in there, and there's not as much opportunity. So I'm kind of moving on to different things. So when the boons kind of went to negative, and I started figuring out that it's what a great opportunity, what a great listed product this is. I started trading a lot of boons, and right now I kind of think that there's an opportunity, and that there's a lot of vol sellers out there. So I'm brushing up, and I think there's going to be a great opportunity for long gamma plays, like for guys that want to buy options. I think that these vol sellers are giving this stuff away, and so I'm brushing up on kind of my option trading, and I don't just mean like buying like, calls betting it's going to go up. I'm talking about like actually, betting, like having an option book and trading, long gamma positions and delta hedging them and stuff, because I think that there's opportunities there. So it's kind of, I am unusual, and I'm kind of more difficult to fit in a box than some other guys. And, at the end of the day, I just kind of take it that I love trading and I love learning about so many different things that, my interests kind of just hop all over the place.
I really like this point. I think it's very interesting because it's quite counter to what many other traders are like, where they really like to specialize in just a few products or a certain type of market or a certain type of strategies or a certain strategy. So why do you think this is? Is it purely because you're just chasing opportunity around the place where you see, potential for gains to be made? Or is there something else to it?
Well, I'm a big believer that everyone has to trade the strategy that works best for their personality. So I by no means think that the guy who trades just, one product is any worse or better than me. It's just different, and everyone needs to find what works for them. Personally, I love the challenge of kind of I know when it came to we spoke about that interlisted arbitrage, automated trading program that I kind of came up with. I designed it. We wrote it together, and I must admit that kind of 6 months or a year into it, I hired the fellow that ended up being my partner kind of afterwards to run it, because I didn't want to run it anymore. I wanted to go figure out the next thing to the next kind of great trade out there. So I just, for me, it's just kind of it's kind of just a desire to always kind of figure out what the next greatest trade. And maybe it's hasn't served me well. Maybe I would have been better off just sitting around trading one thing back and forth. But it's just there's so many interesting things, and for me, I can't help myself. And so like Bitcoin's a perfect example. Like the fellow that works, we have one of the guys that worked with us is a computer guy, and he told me about Bitcoin at $4, and he explained it to me, and I told him that was the dumbest thing I'd ever heard, and and I kind of laughed, because he then kind of a couple months later came back. He goes, that thing that you told me was the dumbest thing in the world is now $20. And, I realized that, if it went to $20, it can go to $100, maybe it can go to $2,000, $3,000. So we started actually mining the things and mining Bitcoins. And we eventually actually created a system to trade them on the various exchanges. And I used some of the techniques that we had learned on interlisted ARB on the same Bitcoin. And so we did all that. And I just loved the game of it all. And it was fun to kind of make this new business, and it was fun to kind of come up and figure out what the issues were, and to kind of try to develop something that can make some money.
It's funny. I gave a talk last week, actually, and one of the points I made is that a lot of really great traders have a genuine curiosity for learning and enjoy the challenge of trading. I mean, they all might express it in slightly different ways, but I think it's certainly the case with you, that's for sure.
Oh yeah, no, I laugh and say, even, if you told me that I had to do this and you were that it paid the same as, a lower paid job, I think I'd still do it. I don't think I would. I'm definitely not one of those fellows that's in it for the money, because I love the game too much.
Yeah, no, that's really cool. So are you still active in Bitcoin today?
So no, basically so we had the miners and we had these, we actually bought the butterfly machines, which were the Butterfly Labs, these fancy machines to mine them. And we actually had a point where our office was so hot because of the heat that it was generated, we had to move them into the garage. And we have all sorts of fun stories about like trading on different exchanges, and the realization that your credit at these exchanges is a real problem. And that's kind of, to me, one of the big issues is that people give their money to these exchanges, and these things aren't regulated. You don't know who these guys are. You don't know if your money's coming back. Like in Mt. Gox, I very quickly realized there was a problem in Mt. Gox. And at one point we kind of said, okay, we went and actually deposited some Bitcoins at every exchange and asked for money back, like did a transaction and asked for money back. And we would time how long the checks would come to get here. And then we would decide on the credit worthiness of the different exchanges based upon how quickly the checks would come. So, but anyways, after kind of it ran to $800 or whatever, it went back down, and I was sure, like if you'd asked me, I was sure it was done. I thought that was it. That was the blow off top, and I never imagined that it would come back up here, and it doesn't really matter because the reality is that it's gotten so much more efficient, and the miners have, the level of sophistication has gone through the roof. So for me to try to compete on that would be kind of just foolish. Like there's too many guys and there's too many smart guys for me to compete with. But when we first started, there was a lot of opportunities and we were lucky enough to take some money out of it.
So Kevin, let's spend a bit of time talking about, let's talk about how you're trading today in current times. Maybe we don't even have to focus on specifically what it is you're trading, as I know that might be irrelevant if someone listens to this in a year's time. But let's talk about how you're trading, because there's kind of two different sides to the way you do things, if I understand right. So on one side, you're very much a macro, bigger term, playing these bigger themes. And then on the other side, you're a very short-term intraday trader as well. So can you just tell us a bit about how those two kind of work together and how you do things?
Sure. Well, work together. It's actually I would say they're more at odds than work together. And it's one of the more difficult things. And having two different time frames in your mind is a very dangerous thing for a trader, because it's easy to turn a short-term trade that goes against you into a longer-term investment. So it's very, I struggle with this all the time to make sure that I don't mix my macro views with my short-term trading. So when I go and if I'm bearish on S&Ps for the macros, on a longer term basis, and then I get up in the morning and everything's screaming buy, and if I'm fighting it kind of because of my macro view, I got a real problem, because it's kind of the two are at odds. And I'll be honest with you, I struggle with that, and it's kind of something I'm continually reminded of all the time. And some of my worst losses are when I'm basically mixing time frames, and it's something you have to be very, very careful of. And in terms of so how I kind of arrange though my trading, so we haven't spoken very much about the letter that I write, but I do write this letter called The Macro Tourist, and in there I will discuss my longer term kind of views, and those will be positions that I will put on and I will hold kind of for weeks, months, maybe even years at times, and those I try to kind of really let them cook. And so if one of my big trades right now is that I'm long treasury bonds or treasury note futures and short boons. Well, I've held this thing for 6 months, and it's a trade with positive carry, and there's a lot of things, and I think that the spread's eventually going to go closer to even. So it's a trade that I I try to find something with a positive risk reward that I can, that might have positive carry. And then I try to let it just, do its magic and hopefully go my way. But in the meantime, I will also on the day-to-day basis be trading the Boon round or trading T-notes round. And those are just strategies that are much more traditional. I do kind of have some things that I've learned throughout the years in terms of my day trading that I truly believe in. Like, I don't know if how many of your readers are familiar with Mark Fisher, the crude oil guy, but he has a system, and he basically believes that, if it's above the opening range breakout, you should only be looking longs. And if it's below, you should be only looking shorts. And I'll tell you, you kind of, you put that system in place, it, eliminates a lot of the the errors that you can make. Because I've often said that the real kind of art to trading is just to figure out which ticket to write first. Meaning that if you're in a kind of bull market, you write a blue ticket first, a buy ticket. Even if you kind of buy it at the worst time, you'd be surprised how much that skates you on side. And the same on the bear market, you write a pink ticket first, and you'd be surprised. Like even if you sell in the hole, oftentimes those things end up being profitable. So deciding which ticket to write first is kind of the real kind of magic to day trading, in my opinion. So I kind of use the Mark Fisher method, like that. If it's above the opening range, I like to write the blues, and if it's below, I write the pinks. I know that's a little simple, but the other thing I like to look at is the VWAP. I think as more and more people have become automated in terms of executing their trades through computerized algorithms, I get a sense of the order flow in terms of whether it's leaning long or short, meaning whether it's consistently trading below or above the VWAP. So if I get a situation where it's, just you get a breakdown out of the opening range and it's below the VWAP and it's been kind of heavy all the time, that's the kind of ideal situation for me. And I know that sounds simple, but I kind of think that in a lot of cases, the day trading is simple, and that you just have to, it's more kind of your demons that the things that you want to do in terms of like trying to buy the bottom and doing all sorts of stupid stuff is really what you need to avoid. And if you do that and then just keep it simple, day trading becomes a lot easier.
Is there ever a situation where you might be, let's say you're long a particular market as a macro trade? Is there ever a time or a situation where you might be short that same market during an intraday trade? Or do you keep the two completely separate?
Oh, for sure. Well, yeah, I basically, I'll think about it in my mind is I'll put aside the macro trade, and if boons are looking strong and I'm short over the long haul, like, for my macro trade, but they're looking strong today, I try to make myself buy them, because I know that the setups and they don't care. My long-term view, it doesn't matter over the short run. So if I see an opportunity to make money over the short run, having the opposing view that I have on a macro long-term view, why should I stop? So I basically, I kind of separate them in my mind, and I go long boons, even though I think over the longer term that they're headed much lower, I'll still buy them.
Okay. Is that something which has gotten easier for you to do over time? Like, I imagine for some people that would be quite difficult to pull off, because you're almost trading against yourself in some ways.
Yeah, you're absolutely correct, and it is difficult. At times I do it great, and other times, every now and then, I definitely wake up with my macro view and I let it affect my day trading view, and it's something that I'm continually on guard for, and it's something I'm trying to get better at. And you're right, it is something that as you do more, you'll get more used to it. You realize that your long-term view doesn't mean anything over the short run. Like that's kind of the end of the day, right? Like that you have to be kind of humble about your long-term view. Actually, you have to be humble about everything in this market. But the moment you start to think that you know too much as well, is the times you get hurt the most, right? So I'm always thinking that there's a chance that I'm going to be wrong. Like I'm always thinking about, this macro view, this could go against me. And in some ways, sometimes if the day trading sets up the other way, it's actually a risk reducing strategy for me. So those are my better days sometimes, because I know I'm kind of lifting risk off the sheets for a short period of time.
Now, if we could, I'd like to drill down into the macro side of things a little further. It's something that is, I guess, spoken about less frequently on this particular podcast. Just from a high level, what are you trying to accomplish as a macro trader? Like the way you see it, what is a macro trader? What's the job of a macro trader?
Well, I guess, and to some extent, I might not be the right person to ask, because I've never had formal training as a macro trader. It just ends up being a kind of a part of the market that I enjoy the most. And to me, what it means is that it's kind of a bigger picture, kind of a jigsaw puzzle with the whole global financial system, and how kind of one piece might move another piece, and how these all go together. And it's a big, huge puzzle. And, like the Chinese are, having trouble with their housing market. So they put more liquidity into the system, which puts more stress on the currency, which then causes this to this and this. And those kind of, different kind of relationships are what really intrigue me. And I just find it's kind of one of the greatest puzzles out there to me is how this huge global financial system kind of all works together. So in terms of how like a macro trader, what they do, I guess what they're trying to do is look for inefficiencies and opportunities within a kind of a global framework. And some guys are kind of more they're like more kind of sophisticated in terms of like ranking different things, and there's all sorts, and that's the other thing about macro traders. There's a whole bunch of different styles out there, and there's a lot of guys doing different stuff. There's like guys that are doing carry trades, they're looking for kind of great opportunities to just kind of earn the carry on some currencies, and they would be generally considered macro traders depending on how they do it. There's other guys that are looking for kind of what the buzzwords about asymmetric, payoff profiles, like they're looking for the next big short. So like there'll be guys that are convinced that, Australian or Canadian housing is the next big short, and they'll be looking for kind of ways to put on a trade to express that view. So there's kind of a myriad of different guys that trade, a million different things. It's such a broad kind of topic that it's very difficult to kind of, because there's so many different countries and there's so many different ways to play it, and there's so many different asset classes. So it ends up being a very, 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 diverse set of, of problem set.
Yeah, there's certainly a lot of moving parts to it. Would you be able to maybe walk us through whether it's recent or a trade you took, a little while back, like a macro trade, whether it worked out or not? But it would just be interesting to hear kind of how you went through it, like how you first developed I guess you might call it a theme or a case, and then how you actually executed that trade, how you managed it through to, from idea to execution to then taking the trade off at the end. I mean, are you able to walk us through an example?
Yeah. So when a perfect example, I think, or a great example is the European situation. When the U.S. went and did their quantitative easing, they were ahead of everybody else because the problems with the great financial crash emanated out of the U.S. So they were the first to do the quantitative easing, and they stayed at it way longer than everyone else. Europe tried to pull their, they've tried to pull up on the gas, and they actually put the breakdown. The previous guy, I can't remember, Trichet, raised rates 2 times after the great financial crisis, and ultimately caused the European crisis of 2011, and basically kind of created the environment where the European economy was extremely weak, and all the problems associated with the different debt. Well, so basically, when Draghi was faced with this European crisis, he went out and got the playbook, and he basically took the same playbook as the U.S. in terms of he just started to quantitative ease, meaning he bought bonds. And I came to the conclusion that everyone was very bearish on European equities, and they thought that it's never going to work. And granted, there are more problems in Europe in terms of the political problems of the union than in the U.S. But I basically came to the conclusion that he's printing enough, and this is going to be a situation very similar to the U.S., meaning that the stock market is going to climb a wall of worry. And I came to the conclusion that that European stocks were a great buy. So I went out and I bought Euro stocks futures, and then I actually came up with a better way to do the trade. And this is kind of just is something that I'm always looking for better ways to express a view. Well, I saw this interview where someone was talking about the fact that there was long dated options listed on the European indexes, and I'm talking really long, like 6, 7, 8 year long dated options. Well, so I priced these out and I had a look at them, and I came to the conclusion that these were a great trade because I could buy long dated options. I can't remember what the percentage was. Let's say it was 10% of the notional. I would pick for an at the money call option. So I could buy an at the money kind of 7-year call option for 10%. And I went through the model and realized that even though rates were negative, if I thought the rates were going to go up, they would actually, that the options would gain even on the rate part of it as well. Like the rho, which is the sensitivity to interest rates. Most people don't kind of put that into a model or don't think about it very much because the reality is on a 3 or 6 month option, it doesn't matter very much. But if you have an option that's 7 years, you'd be surprised how much sensitivity to rho they had. So I came to the conclusion that I could win on both sides of this trade. I could pick up on, when rates went back higher in Europe, because at the time rates were kind of negative, like the 10-year Bund was negative 20 basis points or something, or maybe it was 10. But I kind of said, this is unsustainable. This is ridiculous. These are eventually going to go higher. And at the same time, I think the stock market's going to go higher. So I thought I found an instrument that I thought could win on both sides. And I ended up, I bought these things and I've been patient with them and let them cook. And at the time, a lot of people thought it was insane. And recently it's become more acceptable to be long European equities, but at the time it was definitely kind of an out of consensus opinion. And proving a stop clock is right twice a day. I managed to get one right, and you ask about taking it off. Well, the reality is I haven't taken it off, and that's kind of the sort of trade that the really long ones I hang with for a long time, and I'm not sure when I'm going to take that off. I'm going to wait for the kind of the conditions to change. But in the meantime, they continue to print, and just like when the U.S. we've been climbing this wall of worry. They printed, and the stock market kept going up, and I suspect it'll be the same in Europe.
Do you find that's the case with quite a few of your longer term macro trades, is that you are actually going against general consensus for the most part?
Generally, I'm a little bit of a knife catcher, especially when it comes, on my day trading, I'm not a knife catcher, and I'm more of a trend follower and going with it there. But on my macro positions, my longer term positions, I'm definitely often putting it on when people are going the other way, or at the very least when nobody cares. And I'm actually struggling. If you had to kind of ask me my weaknesses, one of my biggest weaknesses is that when people start to agree with me on a long-term basis, like on those trades, I start to get nervous. And I've often taken trades off too quickly because I've kind of thought, oh, they're crowded now. And that's like something I'm working on, is to hang tough with the trade, even as everyone starts to agree with me. I just end up being such a contrarian on those trades that as when it finally starts to go my way, I'm kind of, it makes me feel uncomfortable.
Right. And how do you manage risk on these positions, on these macro positions? And I guess also, what signals to you that you might be wrong on a position?
So in terms of what signals me is my P&L. And then, I'm used to some pain going against me. Like if you're going to be catching bottoms and taking the other side, it's not like you put these trades on and you're going to time it and it's instantly going to be on side. It's not that kind of thing. So, I'm usually, I usually kind of I'm prepared for some pain when I put on a macro position, and I definitely will let it go against me for a bit. And in terms of how I manage risk, I try to figure out ways to make my portfolio as a whole less risky. And so, for example, if I got in a situation like, where I was long one kind of stock market, or I was long one bond market, I might look for other bond markets or stock markets to hedge a little bit on the other side, or I might kind of think about how it interplays. So if I'm long gold and then long currencies, which will traditionally go together, it might be something I'll think about, and I might reduce one a little bit more, or I might be more prone to take a trade that is, I know, kind of a diversifying trade. So if I'm long, let's say I'm long gold, I really believe in gold, and then I get bearish on a currency, I might be more apt to take that because I know that naturally that's something, gold and currencies will go together. So if I'm long one and short the other, it'll be generally something that'll make it so my portfolio as a whole has less risk.
Okay, got it. As we were talking a little bit earlier, you made a point, and it's certainly not a unique point, but you said that people need to find a way of trading that suits their type of personality. It's something we hear all the time. As someone who is a macro trader, what type of personality or type of trader do you think is well suited to be a macro trader?
Well, that's a great question. So with my letter, I've come to know, actually, I've gotten some great context in terms of people that I've come to meet, and generally these guys are much more traditional macro traders than I. And the one thing that I guess where I'm a little different is I'm sitting around banging S&Ps around all day. They're actually reading, and they're doing things in what I would consider much more slow motion, and that makes sense because if you think about that part of my book, it's actually much slower and less active. So I would say that on the whole, the macro traders end up being a little more cerebral. They end up being somebody who wants to read something, go home, think about it for a day or two, and then put the trade on. It's a little less high paced. They often, I find them going to conferences, and I'm like, where do you find, I'm always kind of shocked at the amount of conferences that they'll be away from the screens way more than I would ever feel comfortable being away from the screens. And it's somebody that kind of just enjoys a puzzle that's a little bit bigger, and it's a little bit has a lot more pieces in it. And that's kind of what if, in terms of somebody that would want to trade macro, somebody maybe that might be a little more kind of academically inclined. You put your guys that were the kind of the jocks that you put them in charge of banging back and forth S&Ps or scalping Intel for ticks and stuff like that, and then you put your generally I would say that they might be more inclined to have the geeky guys trading the macro. That's just my impression. Who knows? I might be completely wrong, and I might have just offended a whole bunch of people. But that's kind of I don't think that the macro traders are generally the cool guys. Apart from the occasional guys like Paul Tudor Jones or stuff, but on the whole, it's kind of the guys that are a little more slow paced.
Sure. Okay. I think you're safe with that. All right, Kevin. Well, we're getting on a bit. While I have you here, I do want you to share one last story, and it's about what encapsulates a great trader. And you have a story that has something to do with the discovery of oil in Norway. And I'd love if you could share this, because I think it will kind of expand people's minds a little further, or at least help in some ways. So yeah, would you like to share that story?
Yeah, sure. No problems. Great. Yeah, it's one of my favorite stories. And I don't know if it's true, but I've never let the truth get in the way of a good story. And it has to do with the Norway, their discovery of oil in the North Sea. And it happened in the late 60s. And in 1969, there was basically an oil driller called Ocean Viking that struck oil in the North Sea. And very quickly, the markets and Norwegians realized that they had hit a lot of oil. And there was a frenzy, and it's a frenzy of like 1998 kind of .com proportion. And all of a sudden, everyone wanted to buy oil. There was people making fortunes because of the amount of oil that they could see that they were going to all of a sudden be pumping, and there was kind of just an epic bubble. And into this bubble, kind of the hero of our story kind of wanders in, and he realizes that the market is very quickly priced in kind of the best scenario, that there's very little money to be made trying to compete, buying all these inflated oil assets, because, the moment that the government started auctioning off the next block of land, speculators were busy, or underwater land, but the next block of drilling rights, the speculators were busy ramping up the price of this, and the frenzy was kind of all over the place, and everybody was busy doing this, and except our speculator, this wise old guy, he kind of had a look at the situation and sized it up, and instead of trying to compete with all those other people, he kind of thought about things for a little bit, and he then started to go and he started to buy all the Norwegian art. And the thing you have to realize about the art market is that the art market is very local. Like, yeah, there's the Picassos and all those, the international, the few guys that kind of transcend all the different international, like everyone wants to own a Picasso and stuff. But let's face it, there's not a lot of demand for Norwegian art, except for by locals. And this kind of wise speculator, he figured out that once these new millionaires, because don't forget, this is 1969 when $1 million was actually a lot of money. Once these millionaires after they kind of had made their fortune and bought some land and maybe bought a boat or two and, gone and done all this stuff, they would start to look for ways to spend their money. And they would buy art, and they would buy local art. And so while nobody was looking, this guy basically bought all the Norwegian local art that he could find. And he bought all the best pieces. And then a couple years later, when all of these millionaires, started looking for excuses to spend their money, something to spend their money on, they started coming. And what do you know? They started bidding up the price of Norwegian art. And sure enough, our speculator was there once it had been bid up to show them a great offering. And that to me kind of just encapsulates what a great speculator is about. It's somebody that's looking, for that edge or that kind of thing that everybody's missing, taking it to the next level and figuring out kind of what the next move will be or what the next couple moves will be down the road. And you know what? When I think about my trading, I always try to, be just like that Norwegian, speculator.
Yeah, I love it, man. It's such a great story. I guess it's the pinnacle of a great macro trade. Am I right?
Yeah, you're absolutely right.
Cool. And I know you wrote about that on your blog, so I'll be sure to include a link to that particular story or article, post, whatever you want to call it, in the show notes as well. Now, your blog or your website is, of course, themacrotourist.com. I want to ask you, Kevin, what made you decide to start writing?
Well, that's funny because actually it originally started as a journal, and it started as a journal to myself. And, I think writing for yourself is a great tool for traders. 90% of trading is mental. And let's face it, you're battling yourself as much as anybody else. And journaling is just such a helpful technique. And so it started as a journal, but then it kind of moved on, and I started to write about the markets just to put my kind of thoughts onto paper. And then I started letting the guys I work with read it. And then every now and then kind of a buddy would phone up and he would say, "What do you think of the market?" And I would let him read it. And eventually I just kind of stuck it on the web and started writing it on kind of pseudo regular basis. And I was kind of surprised when some people started reading it, and they started emailing me and stuff. And I just kind of stuck with it. And I started doing it more and more, and I started to make more contacts, and I really enjoyed it. And you know what? Like, somebody said something to the effect that if you want to really know a subject, teach it. And I can't tell you the number of times that writing a piece has made me kind of formulate exactly what I think. And I don't get away with being kind of wishy-washy and having half-baked ideas, although I guess you might argue some of them are half-baked. But at the very least, it kind of forces me to articulate it. And when you're forced to articulate it, you're really forced to kind of try to wrap your head around it. And so I started writing it kind of on a more serious basis. And since then, it's been great. It's enabled me to meet a lot of people, and it's offered a lot of opportunity to learn from other people. And I've really enjoyed it. So it's just something, I do for free, and you're welcome to go sign up, and you're never going to be spammed, and I'm not selling anything. And my tagline is, all I bring to the party is 25 years of mistakes. And it's kind of just, that's what you're going to get. Cause as much as everyone thinks that there's somebody out there that's the guru that's going to give them all the answers. The reality is that those guys are making mistakes all the time as well. And it's continually, everybody's always learning, and everybody's always being forced to adapt. And it's something that we have to all realize is that nobody else has the answer for us. You have to find it yourself. But by reading and listening to other people's opinions or not opinions, kind of experiences, you start to learn. And actually, while we're talking about this, I just want to take a moment to thank you for this podcast. I've long admired it, and I can't tell you how many of those podcasts I've sat down and listened to other people's kind of processes, and I've learned tons. And even kind of, after 25 or 30 years trading, I find I go and I listen to a different trader, and I'm like, oh, that's a great point, and it's something that I learn. And you're to be commended for this, because it's a great resource you're offering to traders. And I was lucky enough to sit on an institutional trading desk and learn from a lot of great traders. But a lot of other people in my day and age didn't have that opportunity. Well, now you're offering it, and you're actually offering it even better, because you got 130 interviews up there, and they're all terrific, and people can learn from each and every one of them. So you're like, I just want to say thanks, Aaron, because it's a terrific thing you're doing for the whole trading community.
Thank you very much. I greatly appreciate it, Kevin. It means a lot. Thank you. And I'm glad that you threw in your tagline there. I was hoping we would hear that at some point. So if anyone wants to find your blog, it's themacrotourist.com. And you're also on Twitter. What is your Twitter handle, Kevin?
So my Twitter handle is @KevinMuir, MUIR. And and you can feel free to, shoot me a message there, or, you can also sign up for the letter, and you can get my email from there.
Very good. Well, once again, Kevin, I do want to say I really appreciate you coming on the podcast. It's been an absolute blast. Thank you very much.
It's been my pleasure. Thanks for having me.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Every decade, the market reinvents itself. Online brokers open lists. Trade the pool, build strategy, exchange, and clearing fees. FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Welcome, team. Aaron Fifield speaking, and it's great to have you here. Just before I introduce you to my guest on this episode, I would like to give a quick reminder that I'll be hosting a live podcast in Sydney on Tuesday, the 29th of August. So if you're in the area, please make sure you're there. I mean, what better way to spend your Tuesday event to get yourself a ticket, which is a company of DRW Trading. Ever since getting involved in financial markets during 2008, Bobby has gravitated towards mostly illiquid, difficult to trade products. So in some ways, it was almost inevitable that he would begin to explore Bitcoin and other cryptocurrencies. And this was around 2013, while Bobby was vice president at Second Market. In 2014, Bobby became director at Bitcoin exchange ItBit, and then, of course, joining Cumberland Mining in 2016, who are one of the largest institutional liquidity providers in cryptocurrencies. During the episode, Bobby and I got speaking about some pretty interesting things, which ranged from the infrastructure of crypto markets to the curiosity and entrepreneurial mindset which powers DRW, and the challenges of exchange arbitrage to the real-world value of blockchain technology. So without any further delay, here is Bobby Cho for episode 139.
No, let's rock and roll.
Cool. All right, we'll start off by talking a little bit about your background. So, Bobby, I think it would be interesting to hear about some of the things you did before getting into cryptos, because I think in many ways that kind of actually shaped the path, and it makes sense that you've wound up in crypto markets in some ways. So, yeah, tell us a little bit about your background and where you very first got started, essentially.
Yeah, sure. So my background's always been in trading, mostly on the liquid side of things. So when I first graduated college, I went to a firm called Restricted Stock Partners, which then became a company called Second Market, which that business was then bought by NASDAQ. But at my time at Second Market, I was basically on the trading desk for about 6 years, always looking at illiquid securities, products, and assets. So illiquid meaning hard to value, hard to assess, hard to trade, and kind of these unique opportunities. And it's really there where we first got introduced to Bitcoin and the idea of trading Bitcoin. It kind of fell into the same types of products and securities we were trading, aside that it was just Bitcoin. But it was an opaque market. We had to figure out who was trading this thing, what institutions were involved, what it looked like, and really frame out the marketplace, which we did for a number of asset classes previously. But Bitcoin was just kind of a different animal at that time, right? This is back in 2013 or so, when there just wasn't much information as there is today. But that was effectively kind of how I got started. And so after spending a number of years there, helping to build their trading desk, which is now called Genesis Trading, which is a part of Digital Currency Group. And so I moved from there to a company called ItBit. The main kind of catalyst was when we first started looking into the crypto markets. The first thing that shouted out to me right away was, for any professional or institutional trader looking to trade these markets, they need infrastructure, mainly in the form of an exchange that they can rely on, trust, can trade on, and really feel comfortable, sending monies there, holding assets there, holding balances and things of that nature. That's why I decided to go to ItBit. ItBit was, at the time, an exchange that was domiciled in Singapore. They had ideas of breaking into the U.S. markets, and that's kind of where I came into play. So I was the first business hire for ItBit here in the States. They had a few tech guys. But really the idea was, how do we launch a regulated exchange that can service the United States? Whereas the international side of things was up and running, but it was really trying to crack into the US side of things. And so we started thinking about a bunch of ideas of how can we do this. We looked at, all different types of structures. And that's when we landed on something called a trust charter, right? So a financial institution that's regulated at the state level by New York's Department of Financial Services. Other companies that are structured that way are ICE and some other exchanges. And so we ended up getting the first, we'll call it the first digital currency trust company charter, which made us a financial institution. We were subject to all the same things that any kind of bank would be, Basel III capital requirements and things like that. And so that was a huge win, I think, for the industry, because we were trying to do things the right way and try to build a model that now other exchanges, most notably Gemini, has followed and gone down that path as well. And then that led me to DRW, or Cumberland Mining. So way back when, let's go back to 2013, 2014, when I was first looking into these markets, we stumbled upon Cumberland Mining and the guys at DRW. And it was really through that discovery that we realized, wow, there are other institutional traders that are either looking at these markets or trading these markets. And so that's when I decided to join Cumberland after about a little over 2 years at ItBit. And today Cumberland is one of the largest institutional liquidity providers in the broader cryptocurrency space, but mostly focused on Bitcoin and Ethereum. We might make markets and other things as well, but kind of the lion's share of our volume is Bitcoin and Ethereum. And so we work with a number of, whether they're miners, retailers, exchanges, investors, funds, you name them. We are probably dealing with them. And the big part of our business comes from OTC trading. So that basically means anyone looking to trade large institutional size, we have high minimum thresholds, is generally going to come through our desk because, one, the exchanges can't handle that type of liquidity, and two, we just have enough flow throughout the day that we're able to facilitate these transactions relatively close to where market prices are.
Okay, well, let me jump in here, Bobby. Let's just go back a little bit to the point where you were talking about when you came across Bitcoin and you had the realization that if any professional traders and larger institutions were to get involved in this market, there would be a need for some form of a better infrastructure. At the time, I mean, I don't know what year this was. I presume it was probably somewhere around 2012, 2013, but whatever it was, Bitcoin was nowhere near what it is today. Why did you think it would be something that institutions would even be interested in?
Yeah, that's a good question. I think when you actually, well, one, right, the price was much lower back then, right? I want to say somewhere around, maybe $50 to $100, somewhere in that range. So it wasn't the price that was super interesting, although leading up to that point, right, Bitcoin did come from pennies, right, all the way up to that valuation. I think for me personally, it was this idea that my whole career I've spent looking at these esoteric deals, whether it's looking at prospectuses of fixed income deals that were first issued in the early 90s, and trying to find and dig through all that material and finding the value and being able to trade it. That was super interesting to me at a very early stage of my career. So then when I looked at Bitcoin, right, I think like I always say to people who say, well, what's Bitcoin? I always encourage them, well, the first thing you do is read the white paper. I think I had to read the white paper about 8 times over the course of the first 2 years I was introduced to it, just to continue to familiarize myself with what does this thing do, how does it work, and what is the concept behind it. And it really wasn't, that aha moment really didn't come about until I started using it. Through application, that's when it really hit me, the tremendous potential behind Bitcoin at that time. And then just continuing to read about it, you fully understand the potential of it, but at the same time, the utility is not there yet. But obviously, there are tons of folks, hundreds, if not thousands of people working on Bitcoin and other types of cryptocurrencies, trying to figure out some utility behind it and different use cases.
That white paper you mentioned, whereabouts can someone find that?
You can just Google Bitcoin white paper, and it'd probably be one of the first links that pop up. That is probably the first place I would send anybody who is looking to understand Bitcoin, because it definitely gets into kind of the nitty gritty. But at the same time, I think a lot of the original vision of Satoshi has changed. But at the same time, I think that's the best place to start, to actually get kind of where the genesis of this idea came from, and then kind of broaden your search from there. I think today, as opposed to 5 years ago or whenever you want to call it, there's a lot more information out there that's readily available to anybody that's looking to get into the space. Yet still, people have this similar issue where it's almost like too much information. Some information is misleading. Some information they don't know, how to validate it. So even though there's more information out there today, there are a lot of contradicting things that are going on. But I always say start with the white paper.
Okay, and then going back to, was it around 2013 when you first started getting into Bitcoin?
Yeah, I think it was like end of 2013, beginning of 2014, if I remember correctly.
Okay, so like you mentioned, you started out with the white paper. That was really helpful. There was certainly a lot less information, like we just established, around Bitcoin back then. I mean, where else were you getting your information from? Were you talking to certain figures in Bitcoin? Like, how were you trying to feel out this market?
Yeah, I think that was probably the most challenging thing, right? Unlike anything else in other markets, right? So let's take, for example, hey, I'm a new firm and I need to figure out, who's trading, this particular fixed income product. Well, you look it up on Bloomberg, see who the holders are, or maybe you talk with the issuer or things like that. This is like a natural path to being able to frame out certain markets. Bitcoin's different. The reason why it's different is that it's a product that's worked on 24/7 globally, right? So there is not this one niche place where you go to figure out, well, who trades Bitcoin? I think that's the unique and kind of opportunistic part about it. But going back to your question, it really was just scouring blogs, forums. At that time, there wasn't really a big Reddit Bitcoin presence or anything like that. It was literally bitcointalk.org and other types of forums that people were talking about it. And then from there, you start meeting more people and expanding your network. And really, that's how I kind of started out figuring out, well, what's this market look like? And then the more and more you dig, obviously, the more and more people kind of get introduced to you. And that's kind of what happened with the folks at Cumberland DRW. I think we were introduced to them on an email just because at that time, not many people were trading Bitcoin. If you were and people knew about it, they were going to connect you with someone else. And I think people saw that as a natural kind of connection with us.
Yeah. I mean, it's kind of funny to think about in some ways that, here you've got, I guess, quite large professional traders and organizations who are scouring internet forums looking for information. I mean, it's quite ironic in some ways. So that's a little bit about Cumberland Mining. I guess one of the things I'm really interested to hear a little bit more about is, why are crypto markets interesting to DRW? Like, DRW is obviously a very successful firm in traditional markets. Why have they decided to expand into cryptos as well? Like, what's the attraction there?
Yeah, I think just a broad look at DRW, at least in my mind, is you have a number of verticals of businesses, right? And these businesses, whether it's the core trading business, there's a real estate arm, there's a venture capital arm, and then there's this cryptocurrency arm, which is Cumberland Mining. I think a lot of it stems from this idea of people here are curious. They're looking to solve problems. And take aside the traditional business, all that other stuff. If you really look at the crypto markets, I mean, that is, for the curious person, that is a marketplace that really just attracts you. And I'll kind of give you a reason why here. So I often get the question, well, why does the price of Bitcoin move the way it does? Obviously, there's a degree of volatility and things like that, but at the same time, just the sheer amount of variables and inputs related to the Bitcoin market is fascinating to me. And what I mean by that is going back to the example or the thought that, look, this product, right? From our perspective, yes, we are trading this cryptocurrency, but other people look at it as, well, we're trying to build on top of this infrastructure, right? So you have a developer aspect to it. Other people, like retailers, are trying to capture some sort of market share away from whether it's, credit card companies or something like that, right? So that's like another segment. Then you have like the regulatory side of things that, different pieces from all parts of the world are affecting the price of Bitcoin. That's super fascinating to me. That really is something that drives my curiosity, because it's not just 1 + 1 = 2, right? You really have to figure out all these different inputs that are causing different movements in the price of Bitcoin. But yeah, I'd say that kind of what drove the idea here is that, one, I think it kind of fits nicely into the way that DRW and Cumberland kind of position themselves related to the middle of finance and kind of technology, or I guess fintech as people are calling it now, and then just broader understanding different niche, unique markets, trying to solve a problem within it.
And just as you mentioned at the beginning there that Cumberland Mining kind of came out of a sense of curiosity, do you think, just stepping back and looking at the big picture, that that's one of the driving forces of why DRW as a whole is so successful, is because of the curiosity that...
Yeah, absolutely. I think if you don't have that, right, and then you couple that with like some sort of entrepreneurial kind of mindset, right, then you're a in the box thinker. To be honest, I think when I look at our business, let's just take Cumberland, for example, right? This isn't the business itself. There's no cookie cutter recipe to how to build the business, right? And so for me, personally, the unique opportunity to help build a small business within a much larger one helps as well. And to be honest, I think it really comes from the top, right? I think Don Wilson, as the founder, exemplifies that kind of that mantra or that principle of being curious about different markets, investigating different markets, and looking at it from an entrepreneurial perspective, whereas other people may not look at it so.
So let's zoom in a little bit. Cumberland Mining, you kind of described briefly what it is a little earlier. Can we just go into that a little deeper? Like, what's the role of Cumberland Mining in crypto markets? And I mean, I'm sure you feel as though it's quite an important role. Can you just sort of flesh that out for us and make it very clear?
Sure. So Cumberland Mining is one of the largest liquidity providers in the cryptocurrency space. And what I mean by that is that anybody that is looking to get into cryptocurrencies or maybe trade cryptocurrencies, but in a large institutional fashion, would generally want to face us on trades. All the trades that we do here are on a principal basis, so we use our own monies and our own capital for our own risk. We have no investors, shareholders, or clients. Everything we do here is for our own book. And so, whether we play an important market or important role in the markets, that's, I guess, someone's opinion. But I will say that I think we provide a level of, whether it's just institutional, service or something along those lines, that obviously you notice in what DRW does broader in other markets that we try to kind of replicate in the crypto markets. But really the way we try to position the business is and again, Cumberland officially was started in 2014. And I think the original vision is that, look, we see this marketplace going somewhere over the next 5-10 years. Well, how are we going to position ourselves? We need to position ourselves where we sit in between the highway of the crypto markets, which at that time obviously was really kind of a closed place, and also the financial markets, right? So people will say, well, why isn't there more correlation between equities and Bitcoin? Well, because there isn't this natural way to go across both assets, right? I think that's happening. I think you're like kind of seeing it with gold. You're kind of seeing it with other assets. But we really kind of positioned ourselves in the middle there, right? Because we know the financial world very, very well. We have the systems, the technology, the infrastructure in-house to help also facilitate what we've learned, what we've done in the financial world with the crypto world. That goes all the way to just creating best practices in the crypto world, because the infrastructure is just so new and so young that we're trying to help shape that, along with obviously other folks that are working in the industry.
So it would be accurate to say Cumberland Mining is essentially a market-making operation, yeah?
That's correct. Yep. So we provide markets.
Okay. So how does what you do differ from market making in, let's say, equity markets?
Yeah, I think like the main thing is a large part of our business is this OTC business, right? So this large institutional size trading that the exchanges cannot handle, or just the sheer amount of liquidity just isn't there, or the exchange the books can't handle that. And so we kind of created this little niche area where we're trading in and out of in terms of these large block transactions. And that's just how the business is. Obviously, we're going to continue to kind of expand on that and see what the future holds.
Okay. And how do the wide spreads in Bitcoin, and I'm sure some of the other cryptocurrencies as well, I mean, how do these wide spreads work to your advantage, if it is an advantage?
Yeah. So just really quickly going back to what you said earlier, one thing I just want to touch on is the difference between the equity markets and what we're doing today is there's a lot more risk management that comes into play when you trade crypto. Risk management comes from general KYC, general due diligence on the exchanges you're trading on, and just general awareness of the product that you're trading. Because if you think about Bitcoin, right, Bitcoin is a push function. Right? You can't, after you send Bitcoin, it's gone. You can't claw that back or anything like that. So that's why obviously risk management is, I think, a large part of our business. Obviously, long trading, but it goes hand in hand. And then touching on what you mentioned in terms of like wide spreads, advantages or disadvantages, it can play into both parts. Let me go into the disadvantages first. If you were to ask someone what the price of Bitcoin is to 10 different people, they'd all have 10 different answers. So price discovery is still happening. There are a lot of different indices. There are a lot of different prices, a lot of different exchanges. I think like the latest stat I had was like over 200 exchanges worldwide. And I mean, that's a lot for the current market cap of Bitcoin. But yes, does it present opportunities in the marketplace? Absolutely. But at the same time, it's factoring in everything that we just talked about into being able to provide those markets, right? How are we able to provide those markets? Because we've done our due diligence. We've done our homework leading up to the point of obviously trading. So all those things play huge factors into what we do.
Okay. And if spreads were to become tighter, as I'm sure is inevitable, I mean, is that something that would be beneficial? Like, is that something that would help you guys?
I think that's a sign of the maturation of the industry. I think that is, in my mind, somewhere where the marketplace is going. And there will be some formality around it and uniformness. So I welcome that day. And obviously, I think we're still a little bit away from that time. But at the same time, I think most would agree that we are the people working in the Bitcoin industry, whether you're trading, developing a product, running an exchange, doing any number of things. That sign is a general positive sign for the overall industry.
Okay. Yeah.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory exchange and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too small to matter? Good news. With Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, and even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. It's a game changer. Create your account and start trading real shares within minutes. No subscriptions, no minimum deposits, just a one-time evaluation fee starting at $47. That's it. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you ever pay a cent. Every decade, the market reinvents itself, from online brokers to commission-free trading. Now, the new era of limited risk trading has begun. Click the link in the description to start trading with Trade the Pool's capital.
Now, you said just before that managing risk is a huge part of what you do, essentially on a day-to-day basis. Can you also talk to us about how you guys are managing some of the security risks? Because as we know, sometimes Bitcoin exchanges are hacked, different sort of things go on. How do you manage security risks?
We have our own principles for custody and security of our assets. I can't go into the nitty-gritty details, but at the same time, we employ all the best security practices that one could. But I guess touching on kind of the industry and what's happening there are a number of, let's call them custodians out there that are trying to solve for that. And that's honestly the number one question we get from potential counterparties. And this conversation is happening. I've probably had more of these conversations with, fast money institutional guys in the last 6 months than I have my whole time in Bitcoin, in terms of, I want to trade this thing. And we say, okay, great. Obviously, we can help with that. But at the same time, it always gets to the point of custody. So we don't custody anything for anyone, obviously, because we're trading on a principal basis. And then their natural next step is, where should we go custody? And so that is the kind of like the big question when you're first starting out in Bitcoin. But we've been able to kind of navigate that and solve for that at a very, very early stage of our discovery of the company.
Yeah. I mean, I think that's the question that's in the back of everyone's mind when they are new to cryptocurrencies and they're thinking about getting involved in it. Bobby, one of the things I'd like to talk to you about, or ask you about, is the misconceptions that regular people or even some traders have about cryptocurrencies.
Sure. Which ones? There are. I think there are a lot. So I guess which ones?
What did we speak about the other day? So we spoke a little bit, I think, about, the widespreads. People feel as though that there's arbitrage opportunities which are quite hard to capture. I don't know. Do you maybe want to start with something like that? Yeah,
I think we can all agree that markets are efficient, and spreads exist for a reason. And so when people first look at these markets, they say they look at the price discrepancy and they just kind of are amazed at them. But it's really when you start doing your homework behind kind of the exact calculations of why it exists, that's when things start to kind of fall in place. So I'll give you an example. So one, you have to understand that, again, there are hundreds of exchanges out there, right? But let's just take like the top 10 or whatever it is. Those top 10 are probably domiciled in different jurisdictions. So that immediately starts to fragment out liquidity. So fine, you start from there. Then those top 10 exchanges probably have different KYC structures and different regulatory structures. So that further starts to bucket people who want to trade into different areas, right? So maybe one guy in Europe's able to trade on X exchange, but he can't trade on Y exchange. So the spread or let's go back to the profile of the trader. The profile of the trader is different for every single exchange. So the mentality is going to be different there, right? So the characteristics and makeup of the exchange are different. So that can cause one reason why things trade differently on one exchange as opposed to another. And then also you have to start going into trading fees, right? So certain exchanges will have flat fees. Certain exchanges will have, tiered structures based off different percentages or basis points. So that's another point of discrepancy. And then the other thing is depositing and withdrawing dollars or different types of fiat currencies is going to be different for every single exchange. Let's take, for example, that I want to trade. I'm a retail person. I want to trade. I want to buy IBM stock. Well, my options are probably go to, Merrill Edge, Fidelity, Vanguard, wherever you name it. And it's probably just a cheap ACH fee that I pay or that I don't pay that I send money into my exchange or my account. In Bitcoin land, it's very, very different. Some exchanges charge flat dollar-based fees, right? So let's say I'm wiring $1 million to the exchange. They may just take $100 right off the top. Then my bank's probably going to take, $20 to $40. And then their bank's probably going to take another $20 to $40. Then you come to exchanges that charge percentages based off the amount that you're wiring in or out, right? So all these things you start to calculate and start looking at and you say, well, okay, now I see why, certain exchanges are trading at a premium as opposed to others because maybe it's harder to get money out than it is to get money in and vice versa. So I'd say that that's like a misconception in terms of like, hey, these opportunities exist, but when you actually start to delineate out the reasons why, that's when you actually start to see why that spread exists.
So do you think that's true even like once you've got past that initial hurdle, or if it is an initial hurdle, it might be an ongoing hurdle. Once you've kind of learnt the environment like that and who takes what fees and how each exchange is different, is it still very hard to capture those sort of price discrepancies?
I think what the misconception is that there are, no one's really trading Bitcoin, no one's really arbitraging or anything like that. That's why it exists. No, people are certainly trading Bitcoin and arbitraging between different exchanges and figuring out different ways to do so. But that, in my mind, if you just took a snapshot of the exchanges and you look at the spreads between the exchanges, right? Like in my mind, it's pretty much all the same because everything's already been priced in.
I think another misconception that probably a lot of people have, and you might be able to shine some light on this, is actually the real world value of cryptocurrencies. I mean, do you want to speak about that a little bit?
Sure. I think everybody, and this is kind of the really interesting thing about Bitcoin. I think Bitcoin means, or, if you ask people what Bitcoin is or means to them, it vary wildly. So the way I kind of look at like valuations of Bitcoin or anything like that is simply that I kind of look at it as, and again, this isn't going to be the answer for everybody, but going back to what I said about just, hundreds and hundreds of different variables and inputs causing the price to move in certain ways, shape, or form. My background having been involved with a number of venture-backed companies, startups to begin with that have grown. I kind of look at the Bitcoin price as a snapshot every second of whether you call it the health or the growth or whatever the status of Bitcoin, right? So very early on, you'd see Bitcoin move wildly off of headline risk. So news would come out and the market would react accordingly. I think that's less and less so now. But it's still affected by these things that are happening in the market, whether it's regulatory things, whether it's different types of announcements that come out. So when I look at like a private company, and let's take like Facebook, for example, before it went public, if someone had a view into the second by second valuation of Facebook, well, that is going to change wildly throughout the day, right? So on a partnership that they struck, right, the price should go up. Right? Or if a key employee had left, well, then the price may drop a little bit. That's the kind of way I look at the valuation of Bitcoin and the prices. Obviously for us, we're looking at them every second, but I guess I would say that's how I look at the price of Bitcoin and the influence of Bitcoin and how things shift. I don't know if that's what you were going for.
Yeah, in your answer there, are you kind of hinting at the technology which underlies Bitcoin, like the blockchain technology? Are you referencing that in some way?
Yeah, I definitely am. I think, look, I think at first, for people today, what draws them to Bitcoin is just the general price action and volatility, which is fine, right? Fine. You go and look at the price, super interesting, right? Over the last year, over the last 5 years, whatever it is, it's hockey stick growth. But then you start really, in my mind, that's kind of the first magnet to Bitcoin. And then you start looking at, well, why is it like that? Why is the price going up like that? Sure, I'm sure there's a level of just general kind of herd mentality of wanting to buy Bitcoin and hold Bitcoin and speculate on it. But then there definitely is this core amount of investors who actually understand technology and understand that. And again, I had to learn this through application utility. Just the general ease of use and the potential for Bitcoin. I think that there is a level of valuation that is applied to people who kind of understand that side of things.
Well, this is actually something I wanted to ask you about. We see these cryptocurrencies which go up like 50x or however much in a very short period of time, like in the space of just a month, 6 weeks, whatever it might be. They move very quickly. Some of them, they go from a few cents to, dollars and dollars. Are there fundamental reasons for why some of these cryptos move that way? Or, do participants actually value something fundamentally different about those cryptos? Or is it just pure momentum? Because there's also so many cryptocurrencies which just sort of splutter around and don't really do much. And then there's some which just take off. I mean, why does that happen?
Yeah, it's tough to say, right? And I'd be lying if I said that we trade every single cryptocurrency under the sun, but we don't. But a lot of that goes back to risk management, right? Being able to, right, for every single cryptocurrency out there, you have to set up wallet structures, security, all sorts of things that a firm like DRW, it's very difficult for us to move like that. And to be honest, we take a very kind of whether it's just general kind of wait and see approach, simply because there are a lot of projects out there now and a lot of things to investigate. But having said that, I would say that I don't know the exact reasoning of why certain things, kind of go up to, 100x or whatever the price is. But I will say that we look at things over a longer time duration or horizon than maybe most traders. And so while, something may be up on one day, let's see how it looks over next week or month or so. And then let's see what the utility behind it is. And then let's also research it, right? So there's kind of like a three-pronged approach to looking at these markets. I think for certain folks, yes, can you get into these markets and make, a very quick dollar? I'm sure you can. We really try to take a look at a long-term approach with all the markets we kind of look at and make.
Now, Bobby, I want to ask you this one last question. I don't know how you'll feel about it. It's purely just asking for your opinion on this. And, that's all it is an opinion. But what's your take on cryptos as a long-term investment? Because a lot of people have the idea that they might be able to buy some of these altcoins while they're just a few cents, hold on to them. In 10 years' time, they might be the next Bitcoin, ideal scenario. Do you think that thought is flawed in some ways, or do you think it very well could be a worthwhile bet?
I'll just preface and say that I'm not an advisor. We don't provide advisory services or anything like that. But having said that, I'll just concentrate on what we do and what we know. In terms of Bitcoin, I think we're just scratching the surface here. And I'm not even talking about just valuations. I'm talking about technology as well. And I think we look at the general cryptocurrency markets as super interesting. To zero in on one project, I think is very, very difficult. And to be honest, a lot of folks that may be looking at a lot of these projects, ICOs, other different types of cryptocurrencies, a lot of them are tied to, I believe, Ethereum, if it's an ERC20 token. And to be honest, I think if instead of betting on one, then you're probably going to probably invest in Ethereum as a whole instead of just these individual projects. But look, certain people have convictions on certain technologies and certain projects, and so they're left to their own opinion. But at the same time, for us, we just look at these markets and really try to provide value and just the liquidity we're providing.
Of course. Good answer. All right, Bobby. Well, let's leave it at that. I know you're on Twitter. Do you want to share your Twitter handle so anyone listening can follow along?
Sure. It's at Robert J as in Jersey Cho. I don't have many followers, but I welcome new ones.
Good stuff, man. And the Cumberland Mining website, do you want to share that if anyone wants to maybe take a look?
Sure. It's www.cumberlandmining.com. Feel free to look. There's not too much out there, but we're just busy traders.
Excellent, man. Well, I really appreciate you taking the time to do the podcast. I'm glad we could make it happen. So, yeah, thank you very much for doing this.
Awesome. Thanks so much for making time, and look forward to chatting soon.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Every decade, the market reinvents itself. Online brokers opened the doors. Mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool. Limited risk trading. From now on, your trading risk is capped and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade large positions and scale your strategies without risking your own savings. It's time to trade with more capital, actually worth more of your time and effort. Ready to trade the pool? Click the link in the description and join Stock Trading Revolution today. Doesn't your portfolio deserve the best? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Trade smarter with advanced charting tools, backtesting, a pre-built strategy selector, and more features. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involve risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's good, everyone? Welcome back to another episode. I know I just said welcome back, but actually I have a feeling this episode is probably going to attract a few first-time listeners. If you're one of those listeners, then thank you very much for joining me. I am your host, Aaron Fifield. So my guest on this episode is Jimmy Soni. Jimmy, along with his co-author, Rob Goodman, recently wrote the biography of Claude Shannon, which is titled A Mind at Play, How Claude Shannon Invented the Information Age. Shannon was a brilliant mind, plain and simple. He was born in 1916 and he passed away in 2001. He was a mathematician, a scientist, an inventor, and also a stock market investor. Although he's widely unknown by the general public, Shannon is responsible for coming up with what's known as information theory. This is a way of measuring information which stands behind much of the technology we use all day, every day. You may recall Shannon's name has come up on a previous episode, and that was the episode with Edward Thorpe, because Thorpe and Shannon together beat roulette after inventing the world's first wearable computer. I promise you this could easily become a very long intro by taking you through Shannon's long list of achievements, discoveries, and inventions, which do range from artificial intelligence to cryptography to fire-breathing trumpets and chess-playing machines. But instead, keep listening and enjoy a few surprises along the way. I will say you're unlikely to get any trading tactics as such from this episode, even though we do discuss Shannon's investments, but what you will get is perhaps some inspiration for how to become more curious and explore new ideas. Now let's hear from the man who spent literally thousands of hours researching the playful mind of one of the foremost intellects of the 20th century, Claude Shannon. Here is Jimmy Soni. So what's the general response been like for the book? Pretty good?
Oh, it's been great. I think just a couple things. One is, I don't think Rob and I, because we're not engineers or mathematicians, I don't think we fully understood how much of an appetite there was for his story. I think both of us came at this from very different backgrounds. And so we didn't realize that there was a whole community of people, including computer scientists, who see him as this kind of legendary figure. I mean, we knew he was important, but I don't think we understood just how much enthusiasm there would be for his story. So that's been great. The press has been great, and we've got a review in the Wall Street Journal, a review in Nature, Fortune magazine reviewed it, both online and in print. So it's been pretty great, man. I mean, it's been exciting because you put so much time into these things, and seeing one of these take off is really, really great.
Very nice, man. Oh, you must be stoked.
Yeah, it's a lot of fun.
I think I read somewhere that you'd been working on this for close to 5 years. Did I read that correctly?
5 years, and honestly, it might even be a little bit longer than that, but just for a conservative estimate, it's 5 years. The truth is, it just takes that long, in part, just to kind of understand the stuff that he did. And then you've got to add to that, sort of making it relevant for readers, digging through a lot of archival information. We tracked down all of the family members that we could find. We tracked down, an ex-girlfriend, ex-wife, a lot of friends. And so that interviewing that time took a while.
Yeah, I can imagine. So what were you doing prior to writing the book? What is your background?
So my background is, I've done a little bit of everything, but I kind of started my career in consulting and ended up becoming an author. And in between, I've had the chance to do everything from media to politics to speech writing to ghostwriting. And, I think like a lot of people, I always sort of grew up, I was just a real bookworm and always wanted the chance to write books and to kind of if I'm in someone's house and there's a bookshelf, I sort of forget that there are other people in the room and I kind of gravitate to the bookshelf and I sort of cock my head to the side and see what people are reading. And then, I make judgments about them. And so for me, I mean, books are sort of like this, I think about books the way that other people probably think about sort of like baseball or football or like sports they're into. I get into individual authors and I learn everything I can about them and then I buy all their books. And so I feel really privileged to have the chance to write books, and it's a lot of work. And financially, it may not be the most sensible thing to do in a way, but it works for me. And I think if you're lucky enough to do it, you should take the chance to do it.
Yeah. So why did you feel compelled to write this book on Claude Shannon?
Yeah, it's a great question. So I read a book called The Idea Factory by John Gertner. And for your listeners who are interested in how innovation works and how innovative organizations work, I would really recommend that, in addition to picking up the Claude Shannon biography, which is a story of how an innovative mind works, I'd really recommend that they pick up this book, The Idea Factory, because it's the story of a company called Bell Laboratories, which if you can imagine tomorrow, Google, Apple, and Facebook decide that they're announcing a merger and that they're going to become one super company, that is roughly how I like to think about where Bell Labs was in the 20th century for Americans, because it was the second largest employer in the United States. Behind the federal government, it ran the phone system of the United States, so it had essentially a federally guaranteed monopoly, and it was a huge warehouse of innovation. They developed laser, touch-tone dialing, long-distance phone calls, synchronized the sounds and images in movies. They took home 6 Nobel Prizes, invented the transistor. So, I mean, so much of modern life was built at Bell Laboratories. Now, I was reading this book, and it's all about how that company kind of came to be. And one of the figures in the book is Claude Shannon. So I went on Amazon looking for a biography, and I was sort of naive. I just assumed, like, given how important he was, surely there was a biography available. And it turned out nothing came up. There were some books about him, actually a really fantastic book called The Information by James Glick, which is, it's an imposing read, but it's a really good read. But it's about the kind of development and development of the ideas of information and how information has progressed through history. And Shannon's a central figure in that book, but it's not a strict biography, so it doesn't go end to end. And I just kept, like, it's one of those ideas, Aaron, I'm sure you have these ideas where, like, you'll think of something and then it just, like, stays with you, and you wake up and you're thinking about it, and you go to bed and you're thinking about it, and, like, you just walk around with this thing for weeks. And for weeks, all I thought I could think of was, it really is, it's really disappointing that someone so impressive doesn't have a biography of him. And I think when I was gifted the book by a friend of mine, he actually kind of casually threw in the suggestion. He was like, you should really look at this Claude Shannon guy as your next biography. I think that's what led me to look on Amazon. But again, I assumed that somebody had already done it. When I found out no one did, I went to Rob, who I'd been co-writing with for a while. We were both old friends from Duke, and we were debate partners, and then wrote a different book together and worked on things together. And Rob and I together approached Simon & Schuster through the help of our agent. And we were fortunate enough, and I'm sorry if the story is going on a bit, but I think people like to know how books are come to be. So cut me off if I'm...
No, you're totally fine. Keep going, man.
So basically what happened is our agent took us to a meeting with a woman named Alice Mayhew. And that name isn't a famous name, but she's then the editor behind books like A Beautiful Mind, which became the movie with Russell Crowe. She's the editor behind Steve Jobs by Walter Isaacson and all of Walter Isaacson's other books. David Brooks, she's his editor. She's, the editor to The Stars, but Jimmy Carter had a book out and she was the editor. I think she once bumped me on a phone call because she needed to speak to Ruth Bader Ginsburg. And I was like, okay, yeah, totally. You can bump me for Ruth Bader Ginsburg, a Supreme Court justice. I feel fine, And so we sat down with her, and we sort of made the pitch that this was a book that was going to be a lot like A Beautiful Mind. And if for people who haven't read that book, what's wonderful about it is in the movie, you sort of, the heavy emphasis is on the dementia and on the story of John Nash's decline. And it's an extraordinary, story. In the book, the author, Sylvia Nasser, does a really wonderful job of not just going into the dementia and the decline of this Nobel Prize winning mathematician and mind, but she goes into what made his ideas about game theory so revolutionary. And so our contention was that this book, the Claude Shannon biography, would be about the man, but it would also be about the ideas. How did information theory come to pass? How did Claude Shannon think about early efforts at artificial intelligence? What did he think about the stock market? What did he think about money? How did someone like this live his life, basically? But then also kind of intellectually, how did he think? So that was the idea. And Simon & Schuster seemed to, they wanted to take a chance on it. Walter Isaacson had actually written about Claude Shannon in a different book called The Innovators. And so our editor had some familiarity with the topic. And then after we signed the paperwork, we were off to the races.
Right. So why do you think someone had not written his biography sooner?
That's a really, really good question. And it's one that I kind of still wonder about, because if you were looking at the people who are most qualified to do this, Rob and I are probably last on the list, right? The last math class either of us took was in high school. And we're not engineers. I think there are a few reasons. The first is, Shannon himself didn't chase fame, so he didn't really want to be famous. And a lot of people can say that, like it's really easy to sit back and say, well, I don't want all that trouble. Shannon was actually, famous in the 1950s. So he was profiled in Vogue magazine. Some of his work was included in Time magazine. He was on TV. He traveled around the country giving talks. So he had his moment in the kind of mid 1950s where he became a celebrity scientist. And this is in the post-war period. So scientists as a kind of collective, people have a different view of scientists after the war and after the development of the bomb, and after the development of a lot of technology that people thought helped to contribute to the war effort. And so he is this celebrity scientist like Richard Feynman or Albert Einstein, and people are starting to know who he is. And it's right at this time that he just kind of walks off the stage and decides not to become famous. And it's a pretty powerful moment, particularly in like our culture, because if you think about like everyone's trying to become a overnight YouTube star or Instagram celebrity or whatever. But Shannon just decides that it's not for him. He's not going to do those things. Requests keep coming, but he just kind of steadily ignores requests to do various things. He isn't too keen to speak to journalists. He, doesn't give all the talks that he's invited to. That's one reason. He didn't want to be famous. The second reason is, in a way, in order to write a biography, one kind of biography, you need to have a lot of drama in someone's life, right? Like it helps. Actually, I shouldn't say that. It helps to have a lot of drama. It's why so many biographies are written about politicians or about generals, or they've got a lot of activity that you can point to. You can create a story out of it. In Shannon's life, there are some moments that are difficult and some moments that are complicated, but for the most part, the drama in his life is embedded within the discovery of these ideas. And so you have to really want to dive into those ideas and kind of explain how he thought and came up with things in order to tell the story. And so that's part of it. Is I think Shannon can be a bit of an intimidating figure. And then the last reason is just honestly a kind of practical one, which is the Venn diagram, I think, of people who know about Claude Shannon on the sort of one circle and who write books and biographies. That's a thin area in the middle there, right? And so you kind of have to want to dive into fields like mathematics and engineering, and a lot of the people who write biographies either aren't going to do that or aren't willing to do that or just are sort of intimidated by it. And so you have to, it's sort of almost like, the sort of opposite would be like, there's a reason that there's a lot of writers who write about politics, and subsequently there's a lot of political biographies. It's terrain they're familiar with, right? But writing a biography of a mathematician or an engineer, it's a little bit difficult terrain. That's the other reason I think there wasn't a biography at the time.
Yeah, I mean, that totally makes sense. And what were some of the challenges for you in actually putting together this biography? Because like you said earlier, you don't come from a background in mathematics or science or anything in that field. What were some of the challenges for you in actually putting this book together? Because, some of the ideas and some of the research that Claude Shannon's responsible for are fairly complex type of things.
Yeah, I mean, I could talk your ear off about the challenges. I'll go into a couple of them just to spare your listeners the grief and the heartache that we went through. But I would say a couple things. One is it is really difficult to kind of get someone's personality on paper. I think like I'm trying to think about this, describing this in a way that makes sense. It's hard to even describe with a ton of accuracy, like your best friend, right? Like you could write about your best friend, and what shows up on the page, might be a good approximation, but there are probably things you're going to miss or little biases that you have, things like that. And so just becoming kind of literate in anyone's life is a hard thing. So I would say sort of the challenge from the beginning is like kind of developing literacy enough in someone else's life to write about it and make sure that it's accurate, right? That's sort of challenge number one. Challenge number two is he is a brilliant guy. I mean, this was somebody who, as we learned more about him, every time we peeled another layer of the onion and we thought we had gotten down and finished it, we'd find some other thing that he was involved in or some other fact that came up. I can give you the best example of this. We were in the final proofing pages of the book, like the book's about to be sent off to the publisher, and we discovered a plan for his funeral that he had written. It was a kind of like tongue-in-cheek plan that he had written for his funeral. And it was like sort of, he didn't want his funeral to be a sad occasion. He wanted it to be like the Macy's Day Parade. And he had actually imagined what the parade would look like. And so you discover this like at the 11th hour of writing the book, and you're like, well, I can't write a biography and not include the plan that he had for the funeral that he wanted, even though it was a sort of ridiculous, over the top joke. And so every stage of the biography, we learn more about the things that interested him. This was somebody who built a chess playing computer decades before Deep Blue ever beat Garry Kasparov. He built a computer that could play the last 6 moves in a game of chess. He built a machine to solve Rubik's cubes. He gave famous lectures at MIT, and I'm sure we'll get into it a bit, about stock picking and about stocks in general. He was an early investor in several Silicon Valley companies, and when Silicon Valley was just not what it is today. In addition to the obvious, invention of information theory, which is now a field with thousands of people who write papers, and there's conferences and all the rest. So he was somebody who was so multifaceted that you almost like didn't know what direction to go in some ways. Like one of the challenges of the biography is we could have written it at 800 pages, but it was going to be compelling. It was going to be hard enough to get people to read it at 300 and whatever pages, 375 pages. And so taking all of that and finding ways to kind of pare it down was one of the other challenges. And then the final thing I would say is, we had to spend about 3 years convincing his family that we weren't crazy and that we weren't going to ruin their dad's legacy and that we weren't kind of imposters. It took a really long time to get the family to warm up to us, because this was a family that, like their father, didn't want fame, didn't search it out, didn't trade on the family name. And so they were very skeptical, and they'd been, I think, burned in the past by some people who had been writing some things that weren't 100% accurate. And so it took a lot of engaging and gentle emails and, hey, we found this, think you'd really cool. Like, you may not have seen this about your dad before. That took about 3 years of just patient calls and emails and messages and communicating. And so that's the last part, was sort of getting the family on board. But honestly, Aaron, the second half of the book, we couldn't have written without the family's participation. So it was so important to play that kind of long game with it.
Now, you've made an interesting point about how Claude Shannon wasn't someone who was chasing fame. Of course, he was very deserving of fame, considering his achievements and the things he had discovered and invented, etc. Why was he not looking for the spotlight? Like, why did he shy away from it, I guess, is a better way of asking the question.
Yeah, no, it's a really good question. So a couple of things. One is Claude Shannon was one of these people who basically never did anything that he didn't want to do. There was a brief period in his life where he had to do some things, get his PhD, his master's. He had to work for Bell Labs and do some cryptographic analysis. And after his information theory paper, once he's sort of established as like a scientific, brilliant person, he basically just pursues whatever he wants to pursue. And what I mean by that isn't that he got lazy. It's that he would go where his mind led him. He didn't have to go where the money led him or where fame led him. It just wasn't, A, it wasn't a motivator, but B, he just didn't need it. He could kind of do what he wanted. And so he was privileged in a sense. Obviously, the privilege came as a result of very hard work on information theory. But he was privileged to be able to basically do whatever he wanted to do. And what he wanted to do was pursue puzzles. It was to build things. It was to write new mathematics. It was to take the field that he developed and bring it to maturity. He had private interests that just occupied him. And the idea of giving paid lectures or of going on TV to talk about things just did not fit in that schema, right? And so what's interesting is this is somebody who I think for most of us, if we had the opportunity to be on TV and to be in magazines and all the rest, we would run to that opportunity because it would help us do all of these other things that we wanted to do, right? There's a sort of instrumental quality. Like you can use all of that to do these other things. For Claude Shannon, those things were an interference with the stuff that he actually wanted to do. In his house later in life, he builds a 2-story workshop, and journalists dubbed it the toy room. His kids don't really like that. They called it Dad's room. And if you can imagine a 2-story workshop where this kind of brilliant mind comes in and just builds and compiles things and is, soldering things and, just constructing crazy contraptions. He built a trumpet that could breathe fire, just to give you an example. So when you played it, fire would shoot out of the bell of the trumpet. There's no reason for this. There's no great, innovation award or anything. It was just what he wanted to do. And so he had this space, and I think he was at his happiest in that room, building contraptions and making things and puzzling over things that he thought about. I don't think, even in the interviews with journalists later, he's pretty snarky. Like somebody once asked him, they say, "Did you ever find fame to be a burden?" And he responds, "Well, the only burden is having people like you come and having to talk to people like you." And he's sort of doing it with a smile, but there's a little bit of snark there because he's saying that like he has zero interest in, kind of engaging in this way. And I think that was it. I think the long answer to your question is he just didn't see the value in it, and he didn't want to do it. And he was the kind of person who had earned the right to do and to study and to focus on the things that he wanted to do, which were, math and artificial intelligence, computing, additional theoretical work, engaging with people who were kind of at the intersection of all of those fields. That's where his interests were.
Yeah, the little bits I've read about Claude Shannon, I kind of got that impression. I kind of got that vibe that he was someone who really just did whatever he really wanted to do. If he lost interest in something, he'd just push that aside and move on to the next thing, which was of interest to him. I really kind of got that sense.
It's actually one of I think the most powerful lessons I took from studying his life, which is it's okay to dabble. He was a famous dabbler. I mean, he tried everything. He was a jazz clarinetist. He built machines, played chess at a very high level, went to Vegas with a wearable computer he built to try to beat the roulette tables. He, obviously did a ton of work on math. He gave speeches about early computing. He was involved in artificial. I mean, I could go on and on. The point is, he did not think that everything that he did had some kind of specific end goal or end result. He was a dabbler. He would pick things up, get interested in them for a little while, finish them, and by the way, finish them to usually an obscenely high degree, and then all of a sudden just shift his interest to something else. And so I think there's something to be said for that kind of mind, that kind of engagement, just because I think that a lot of us feel pressure to really specialize and to get really good at one thing. Shannon's a useful reminder that dabbling's okay, and that you can actually learn a lot by becoming a kind of by just becoming broadly curious. One of the things that Shannon did, he was interested in poetry. He was interested in philosophy. So I do think that there's something, you're absolutely right to nail that part of his character. He was somebody who picked things up and set them aside just based on his satisfaction. I think there's actually a lot of value in that for people who are doing anything, whether it's, trading stocks or, driving trucks. I think there's value in that kind of generalist thinking.
And I guess that's one of the reasons why you appropriately titled the book, A Mind at Play.
That's right. And part of it too is he was playful. I mean, the guy had a lot of fun. There's this great moment. He has a really good time sort of poking fun at serious institutions. So one of the things he does is he gets all these like honorary degrees from universities. So he'll get like, the hood and the whatever. And for most people, like an honorary degree is a really big deal, and they kind of can get it framed or put it up on get the hood and the thing framed or whatever. And and they treat these things as really as a significant moment in life. And Shannon, he saw their significance and he was respectful, but he won so many of them that he built a sort of like one of these rotating tie racks. And the honorary degrees the hoods were just placed on a rotating tie rack. And when he would push a button, the tie rack would just rotate. So he'd be able to see all of them. He got an award from the American Philosophical Society once, and it was just an invitation to join the society. And the society was started by Ben Franklin, so it goes back a couple hundred years. And it's for famous thinkers and scientists and that. And they sent him an invitation, and the invitation was, what he could tell was it was a facsimile of calligraphy. So it wasn't real calligraphy. It was like somebody had copied it or done it from a computer. And so he hired an actual calligrapher to write back his letter of acceptance, just as a joke. And actually, the American Philosophical Society still has his hand calligraphed acceptance of their fake calligraphed invitation. So he had all these moments where he was just very playful and joking. He gets a fellowship to go to Oxford, and the only remaining record from that period is that he's so upset as an American to have to drive on the wrong side of the road that he writes a 3,000 word paper where he designs a system of mirrors and levers so that if you sat in the car, the British car, and you drove down the left side of the road, it would feel like you were on the right side of the road. And this was like an elaborate paper with diagrams and math and all the rest. But this is what he spent his time thinking about. He was very playful, and I hope it comes across in the book. But I think there's something to learn from that too, because he was one of these people who, we tend to think of geniuses as these like tortured, dark figures. And Shannon was almost the exact opposite. He was much more Richard Feynman than John Nash. Okay.
In saying that, though, were there some moments in his life where things were a little bit dark? I'm not sure why, but I feel like I've read Fortune's Formula, which I know speaks about Shannon quite a bit, and I don't know if maybe I'm getting him confused with someone else, but were there some periods in his life where he was a little bit unhappy?
Oh, yeah. There was a pretty deeply dark episode, a couple of them, but really centered around his 20s. So, I just was to set the scene a bit. He has graduated from MIT with his PhD. He wins a fellowship to go to Princeton's Institute for Advanced Study, and he's just gotten married, and his marriage is on the rocks. He and his later ex-wife they don't have a lot in common. She's very social and gregarious, and she's interested in politics, and he's not so into that. That's not his thing. And he's kind of morose, and she thinks he's depressed. A couple of other people have indicated that he might have been depressed. So that's happening. His marriage is on the rocks. He doesn't quite know what he wants to do professionally, so he's sort of struggling with that like mid-20s anxiety of like, well, how you're going to spend your life. And then the last thing, and probably the thing that most affected him, is World War II is underway. The American involvement in World War II is underway. And the draft is about to be announced. And then once it is announced, this is a huge source of anxiety for men of his generation. It's a particular source of anxiety for Claude Shannon because he does not want to join the military. He knows he's frail. He doesn't think he's fit for combat. He also knows he's a loner, so he doesn't think he's fit for kind of the close quarters of Army life. And so all of these things combined to kind of to really put him down in the dumps in a pretty serious way that people kind of still remember. Those who were around then still remember to this day. And it's the period that where we would say if Shannon had was sort of one great challenge among the great challenges in his life, that was certainly kind of the greatest challenge, was that moment right then and there. is able, so his marriage ends, unfortunately. But he is able to secure some funding from the National Defense Research Council, the NRDC, and he is able to go to Bell Laboratories to work on research for the war. So Bell Labs is subcontracted by the government to do a lot of research for the war on a lot of different topics. And he's one of the folks who manages to win a research grant. So it kind of gets him out of where he is into Bell Labs. He manages to avoid the draft, and that kind of gets him out of that period of his life. There's still some bumpy things that happen in New York. He has some different things happen over time, but there's that period is probably the darkest period in his life. And it's not just him. I mean, it was an entire generation of men who faced the pressure of the war and had to contend with it in different ways. And for Shannon, he was really fortunate in being able to get that time.
Right. Okay.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory exchange and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too small to matter? Good news. With Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, and even the newest IPOs. And short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. It's a game changer. Create your account and start trading real shares within minutes. No subscriptions, no minimum deposits, just a one-time evaluation fee starting at $47. That's it. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you ever pay a cent. Every decade, the market reinvents itself, from online brokers to commission-free trading. Now, the new era of limited risk trading has begun. Click the link in the description to start trading with Trade the Pool's capital.
Well, I think what might be interesting is if we hear a little bit about where Claude Shannon actually came from and what was life like for him growing up? Where did he come from?
Yeah, so he was born in a town called Petoskey, Michigan, in sort of the upper part of Michigan. He grows up primarily in a town called Gaylord, Michigan, and Gaylord is a kind of classic small town. I mean, it's I think at its biggest when Claude Shannon is young is like 3,000 people. Just to give your listeners a sense of kind of how small and what time, when the first electric light is installed on a sign in Gaylord, it becomes front page news, and the town comes out to celebrate. When we were looking at the papers from that era, the Shannon's parents' wedding makes the front page, and they weren't, his parents were important in the town, but not important enough. It goes to show how small this town was that his parents' wedding makes front page news. Other headlines were things like "Woman kills wolf with mop stick." There's things like that pepper the papers from that period. So he grows up in this town, Gaylord, and he's the son of Claude Elwood Shannon Sr. And Mabel Wolfe. Mabel is his second wife of Claude's dad, and we don't know the circumstances around his first marriage, but he was older when Shannon was born, and so he remains a kind of distant figure in Shannon's life. He's not super engaged with his son's life. even later, Shannon didn't really have much to say about him. His dad is one of these people in one of these small towns who does a little bit of everything. He's the undertaker, he's a lawyer, he's a judge, he sort of participates in all aspects of life. And he's most famous for his time kind of serving as a judge. It's where he earns the name Judge Shannon. Claude Shannon's mom is a teacher, and she's a sort of musician locally. And he lives a fairly standard life. I mean, I think in a lot of lives of geniuses, you sort of see these overbearing parents or like dads who are convinced that they're going to turn their kids into geniuses. You see this with Beethoven or with John Stuart Mill. Shannon's life is really ordinary. We sort of joke, it's like what you would call now like free range parenting. His parents kind of let him do whatever he would like to do. So he goes and he builds radios, he tinkers, he builds a barn elevator with a friend in their backyard that works. They both live to tell about it. He's in the Boy Scouts and he does things like that. And so he's got this life that's very rich and varied. He's good at school. He definitely shows some acumen for some things. It sounds like from what we can gather that the reason he became interested in mathematics is partly because his sister was interested in mathematics. And so he sort of has this little bit of like sibling rivalry, and it leads him into math. And he has this very ordinary childhood. A couple things that are a little bit extraordinary about it. One is he, at a very early age, becomes interested in codes and kind of cryptographic analysis. So he's like always playing with codes. There's a famous Edgar Allan Poe story called The Gold Bug, and that becomes Claude Shannon's favorite story as a boy. It's the only Edgar Allan Poe story with this gigantic code that's supposed to help unlock a treasure within the story. And I think it's fitting that it becomes Claude Shannon's favorite story. So he's got that interest. And then he's also, he manages to find his way to the University of Michigan. So that's the second kind of important thing from his childhood. So he applies to the University of Michigan. It's really quaint. I mean, the application is I think 3 pages, fill in the blank, and he makes some spelling errors and he just crosses out the spelling errors. It's not nearly as stressful as applying for colleges today. The reason it's important that he ends up there is because the engineering school at the University of Michigan has exploded in the kind of 10 years prior to his getting there. And so he's arriving at a time when the engineering school is big and growing and powerful. And so he's exposed to a lot of very cutting edge engineering research as a result. And it's probably the kind of second kind of consequential thing in his life, at least his early life.
Yeah, I mean, one of the things I found really incredible about his childhood was even the things he was inventing and creating at such a young age. Like I've read in a couple places that he built some sort of wireless telegraph system between his house and his friend's house, which it wasn't overly close either. Like how did he have the know-how to create these sort of things? Like, was he just a smart mind from the get-go?
Yeah, it's a great question. And I'll be honest that I think even after writing his biography, I think these are the kinds of questions that you can sort of speculate at, but not necessarily pin down for sure. I would offer a couple things. One is he did always have a gift for building and making things. So even as a boy, the network you're describing is this kind of barbed wire network that connects a friend's house, which is about a half mile away, to his house. And that doesn't like seem all that remarkable to us because like I pick up my iPhone and text my friends, right? But this is the early 1900s. And so you're talking about a time when this kind of technology is farmers use it to communicate with each other. But then you have this boy who builds this network and is able to communicate with his buddy at a time when the phone system is still relatively immature in the United States, and that not everybody has a phone. And so it's sort of, yes, in a way he had the kind of sense to do this. The other thing is like he came of age in a town. The thing that Gaylord is famous for is making things. So they're like a lumber town. They become they become at the intersection of some major railroads because there's a lot of wood that's in the area and it's being harvested. And so Gaylord, it's a very practical, hard-headed Midwestern town. People build things. They make sleighs and they make 10 pins and they make all these things. And so you're sort of thinking, contrast that, for example, with like a more cosmopolitan upbringing in New York or in Boston, even in that era. And Shannon would have turned out to be a very different person because he wouldn't have built things, right? He would have been riding the early subway, and he would have been, seeing people go into offices. But his dad is a furniture maker. So one of the things that we found was actually the ads that his dad took out in the local paper that were furniture ads for a variety of things. And so his dad is making things. Shannon has a grandfather who's actually an inventor as well, who has a patent for an early washing machine. So this is in the gene pool. It turns out later that Shannon discovers he's a distant relative of Thomas Edison. So he's actually got the sort of like inspiration from that family connection. But I think more precisely, it's that he grows up in a town where if you needed something, you made it. You didn't buy it. And, it's a spirit I would love to recapture. I just don't have any sense of how I'm going to do that. Because right now, if I take apart my iPhone, I'll violate Apple's terms of service. So it's not like it's something we can all redo. But for Shannon, that was a part of how he grew up. And you combined it, I imagine, with some natural intelligence, which he obviously had, and then some training in places like the University of Michigan and later MIT and Princeton. And I think it creates the kind of mind that does that. But I do think that growing up in that kind of small town, making the kinds of things he did, playing with broken radios and having to figure them out, building networks to communicate with your friends, all of this was a big part of why he became the person he became.
Yeah, I mean, it's incredible. Like, you've got to remember that this was in the early 1900s. Like, he was born, was it 1913? 1916.
1916, yeah.
Yeah. Like, if we want to know how to do something now, it's as simple as pulling up your browser and typing it into the search box, where back then, I mean, it was just an entirely different world.
Well, and if you think about it, like one of the inventions that most struck us was that he and this friend Rodney, one of his best friends growing up was this guy named Rodney, and he and Rodney, there was a barn in the back of Rodney's house, and they built an elevator, right? These are kids. And like, if someone, I'm an adult, and if somebody asked me to build an elevator today, I would not know where to start. Like,
exactly. That's
honestly,
what I
mean. I'd have to go to Google. And even then, even with Google, I wouldn't trust any elevator that I built, right? Like, that wouldn't turn out well for anyone. He builds an elevator and it works. And we know it works because later, Rodney's sister, decades later in the 1980s, she gives an interview where she talks about how she took the ride on the elevator and lives to tell about it and tells his paper about it. But he's in this kind of community, and it's a really practical Midwestern small town community.
So one of the breakthrough discoveries or things which those who know Claude Shannon best know him for is coming up with the information theory. Do you just want to start this off by telling us what is information theory? I know it can be a very complex subject, but is there a way you can explain it in somewhat simple terms?
Absolutely. Or at least I'll do my best with it. The basic idea is, until Claude Shannon, people thought that there was nothing in common between, let's say, a telegraph signal, a telephone signal, a tweet, and this call that we're having, that they had no properties in common, right? Shannon shows, one thing he shows is actually all kinds of communication are reducible to the same basic things. So he provides a framework that's 6 boxes. People can look it up online, thanks to Shannon. But it's 6 boxes, and it sort of shows you how a message gets from point A to point B, and that all messages, regardless of the length, the medium, the kind of message, what you're saying, how you're saying it, they're all reducible to these same essential ingredients. So that's kind of essential insight number 1. Essential insight number 2 is once you can do that, you can encode or quantify it. You can quantify messages. So he invents the bit. Actually, the bit has a great origin story. He was going to refer to it as the binary digit, but he's trading ideas with people at the lunch table at Bell Labs, and they're like, well, binary digit's 2 words, it's too long. You should take them and combine them and make them into bit. So he comes up with bits. That's the measure of information can be credited to Claude Shannon. So the thing about that is like, it doesn't seem like a big deal to us, but there was no way to measure information prior to this. There were attempts, and he had worked with a couple of people who had tried to come up with a kind of quantification for information. But Claude Shannon is the one who sort of lays it down in its clearest form and says, this is how you measure information. The final sort of set of things that he comes around, and again, this paper is very dense, and like you said, we could go on for a while, is once you can measure something, you can encode it and you can compress it. So the fact that you can watch a YouTube video and it doesn't take a couple weeks to load is because of compression. And the idea of compression algorithms, of being able to take out pieces of things to be able to compress something down to its essential size, that is credited to Claude Shannon. And so one of the things that, for example, he shows is that in a basic sentence, if you took out the vowels from most of the words, most people would have not too much difficulty interpreting what you said, right? So like if you were to write a sentence out, take out the vowels, for the most part, people will be able to read a sentence and sort of stumble their way through it. Well, what he's showing there is that a lot of language is redundant, that there's redundancy in language. And if you pull out the redundancies, you can do two things. One is you can make a message smaller so you can compress information. But the other is that you can actually encode information to make sure that when you send a message from point A to point B, that you can repeat certain letters or certain statements to make sure that it gets there accurately. So Claude Shannon and the theory of information is basically the science of how do you quantify information, how do you encode information, and how do you compress information.
Now, was this something Shannon came up with deliberately? Like, did he set out to research this sort of thing, or did he kind of discover it through a spin-off of something else? Like, what inspired him to look into this?
Right. So it's a long process, and it's worth getting into it a little bit because I think it's actually kind of inspiring for those of us who work on nights and weekends, because this is a nights and weekends project. So in the late 1930s, it's the first record we have. He sends a note to his graduate school advisor where he basically tells him, I've been thinking about some of the fundamental properties across all messages and all kinds of communications, right? And the reason that he can even say a statement like that is because from boyhood until that time, he has played around with barbed wire networks. He has, studied engineering at the University of Michigan. He has worked on cryptography and code breaking for the U.S. war effort at Bell Labs. He's worked at the phone company, so he's seen how those messages travel. So he's been exposed to all these different kinds of messages and forms of communication, and he starts to see that there are these ingredients that are common to all of them, right? So that basically percolates from 1939, 1938 until 1948, so roughly a period of 10 years. And what he does when he's not working at Bell Labs during the latter part of that time is he's writing this paper, and he's working away at it. As best as we can tell, he's basically working at away on the side. And then in 1948, he publishes it in the academic journal that Bell Labs runs called the Bell Systems Technical Journal. And just a brief aside, it's sort of extraordinary that this private sector company runs this academic journal where they publish these sorts of papers. It's a kind of amazing thing. But he publishes this 77-page paper, and as someone put it, it came like a bomb because he hadn't discussed it with anyone. He had not talked about it. He had sort of made passing references to things, but it wasn't the kind of paper that he was bouncing off a lot of people, publishing early versions, etc. He had sort of dropped it like a bomb, and it invented an entire field and solved most of that field's central questions, at least the kind of broad outlines of those questions. And so you have a situation in which, this kind of comes out of nowhere, but it's really been in his head and he's been working over it for 10 years. And there's a lot baked into it. It's studies in linguistics, and it's studies in mathematics, and it's studies in engineering. And it's, he was a jazz musician, so there's probably even some elements of that in there. So all of this is baked into that paper, and that's how it comes to be. And when it lands, people know almost immediately, they know this is something significant. And then papers start to be derived from it, which is really important in academic circles. So people use it as a jumping off point for their own work. And then over the next, I would say 5 years, the most important moment actually is a year later when he initially publishes the paper and he titles it a mathematical theory of communication, just a mathematical theory. By the following year, it's referred to as the mathematical theory of communication. So people recognize that it's definitive.
Just so everyone listening really can get a grasp on this and just how important information theory has been to the sorts of technology that we almost take for granted these days. Like, where would we be today if it wasn't for information theory? Like, what sort of things would we potentially not have?
Yeah, it's a really, really good question. It's one of these things that it's kind of hard to say exactly because so a good way to think about it is, there are sort of like Copernicus, right? Would we have discovered at some point that the Earth revolves around the sun instead of the other way around? Yes, in time somebody other than Copernicus would have come along and found that out, and I suspect the same sort of thing would happen, and we would refer to that person's name, and it might be called, if it was you, Aaron, it'd be the Fifield Revolution, right? The Copernican Revolution. We'd call it the Fifield Revolution, and we'd credit Aaron Fifield with discovering that in fact the Earth revolves around the sun, not the other way around. So, is it possible that someone would have come around and discovered exactly what Shannon did 10 years after, 5 years after, or 2 decades after? Yes. And there were other people in the space working around these ideas. Norbert Wiener is a famous example. And he and Shannon are actually at one point kind of in a sprint to get their papers out, because Wiener has many of these same ideas. There are some important differences that we go into in the book, but he is also working in these fields. Shannon also had a couple of important predecessors who began the process of quantifying information, turning it from this idea into this sort of very hard science. So do I think that eventually somebody would have figured this out? Yes. I will say that I think Shannon's work, in a way, gave engineers the practical tools to bring many of the technologies we have to pass more quickly. So the codes that Shannon comes up with are really not used at the time, because remember, he's doing this in 1948. So the world is still analog. Computers are still the size of rooms. Nobody has phones. Nobody has an iPhone. It's the satellites don't exist. All that. What the first time his codes are used is in the 1980s, and so the question is, would that have happened eventually? Probably, but maybe it would have been the 1990s when those codes are first used instead of the 1980s. But after his work comes into use, it's basically the gold standard, and it's used for all kinds of engineering applications. And many people who follow Shannon take his work and develop it further. And there are a lot of famous technologists and technologies that people that build and grow from that. I think I'll offer a couple more thoughts, because I know this is a little bit all over the place, because I think it's just a hard question to answer, right? It is like saying, well, if Charles Darwin hadn't been around, when would we have discovered evolution? I think that there are certain discoveries that can seem trivial, but they're only trivial after the fact. Right. So they're only trivial once someone's come around and done them. And then it's like, oh, of course evolution exists. I know it's still debated today, but let's just, for the sake of argument, just accept certain premises. Well, of course it exists. And so you've got this situation in which, like, well, of course information is transmitted this way. And of course bits can be used to quantify information. But I think it's one of those things where you can only say, of course, because someone like Claude Shannon spent 10 years writing this 77-page paper that essentially defined this field. And what that field leads to is our ability to have this call over Skype while you are in Australia and I am here, because the messages that you're sending and that I'm sending are able to be encoded and compressed and transmitted. And yes, there are other people who developed Skype and the laptops you and I are talking on and the microphones we're using, but the underlying architecture for how that communication happens belongs to Claude Shannon.
Yeah. Now, is it true that Shannon almost, I don't know what the right word is, but like almost discarded the idea after a while? Like he, as you described, he kind of dropped this bomb. He's responsible for introducing information theory. But after like a few years, he kind of stopped working on it or kind of left it for other people to develop the idea further. Is there some truth to that?
There is. I don't think it's as true as people think, but there is definitely some truth to it. So, one of the things to get back, this actually is a good sort of, gets us back to where we started, which is Shannon was somebody who picked things up, did them to whatever satisfaction he thought was necessary, and then moved on. And in the same way, information theory kind of became like that. He could have traded on information theory and just became an information theorist whole hog for the rest of his life. But he had a lot of other things that interested him, and he wanted to pursue them. And so he did. And so what happens is once he publishes the paper, he does write a lot for the next decade and a half. And he co-authors papers with people like Bob Fano and Bob Gallagher, who are kind of two of his acolytes who end up picking up the mantle where he leaves it. But he's not. There comes a point when he's a professor at MIT, and we spoke to a lot of people who were there, and they basically said like he was supposed to be this kind of world-class information theorist who was going to help our department get to its next great level. And then it turns out like he'd kind of lost interest in it and just didn't want to participate in that. And I think part of it is that he had found other interests. He became interested in juggling and in chess and in AI and in computers. And so his interest moved on. And so there is some truth to it. Now, the thing I would object to, people will say things like, well, after 1948, he doesn't do anything significant on information theory. And I don't think that's true, because we do have a record and some decent both published and unpublished papers in the field that do contribute to the body of knowledge. But probably the most important thing he did was he published this paper that led all of these other very intelligent people into this field who then developed the things and took it further. So I do think there's some truth to it, but I'm not sure that I'd go as far as some people have. Okay,
got it. Well, let's speak a little bit about Claude Shannon's interest in the stock market. So at what point did Shannon actually turn his attention to investing?
Right. So there's some dispute about it, but as best as we can tell, it starts in the kind of 1960s and the 1970s. And actually, it's important to correct the record on one thing, which is people think that like this brilliant mathematician picked up the Wall Street Journal and came up with all these theories and made a lot of money. And it's actually not Claude Shannon who becomes first interested in the stock market. It's his wife, his second wife, Betty Shannon. And Betty is this kind of extraordinary figure who deserves a lot more credit than she's gotten. And I hope the book starts to correct some of that. I hate to say this, but she passed away just 3 or 4 months ago before the book was published. But we managed to secure an interview with her before she died. And one of the things that both she and her daughter talk about is how the stock market actually was not an interest of his until his wife becomes intrigued by it. And so they start buying books. They buy Adam Smith's Wealth of Nations. They buy books by people like Benjamin Graham. They buy all these. There's a title. I haven't read this book, but there's a title of a book I thought was pretty funny, which is why don't the customers have yachts?
Right.
Something like that. So they read books like that. They become intrigued by the literature on the market. Then they start doing some early investing. They kind of day trade. They play around with things, and as mathematicians, and Betty, by the way, his wife, was also a trained mathematician, they kind of get intrigued. For Shannon, the market was this extraordinary puzzle of money moving here and there. And so he just wanted to understand the puzzle in the same way that he wanted to understand how to build a computer that could play chess. So in the 1960s and 70s, they start becoming intrigued, and it's in the 1970s in which he gives a few famous lectures at MIT about some of his investing theories and what would make sense and what doesn't, what's worked for him and what hasn't. We can go into those if you like. I mean, that he himself knows that they are exercises in kind of theoretically understanding the stock market. They're not the most practical investing strategies, but the upshot of all of his work in the market is his most successful investments are instances in which he befriends somebody who is going to start a company and manages to get in on the ground floor of it. And so he gets in on the ground floor of a company called Teledyne. He gets in on the ground floor of a company called Harrison Technologies that is later acquired by Hewlett Packard. So because of his role in information theory, he gets to know all these guys who are early Silicon Valley people. And they obviously want someone like Claude Shannon to be, on the board and to own stock and all the rest. And so that's how it happens for him. And that's a lot of where his stock market wealth comes from, is not necessarily active trading. It is getting it on the ground floor and then just holding on for a very long time.
Right. Yeah. Because he was very much a fundamentalist, right? Like, is someone who's a very intelligent mathematician, you would kind of presume that they would be doing something other than obviously trading off or investing off fundamentals. But that was like his whole thing, wasn't it? Is knowing the company fundamentals.
It's so interesting, right? Because you would think that he's this genius mathematician. He's working on all the complicated equations and everything else. And at the end of it all, like when asked later in life, kind of what sort of things do you look for in a stock, or how do you pick stocks? He just says, look, you look for good management, a good product, all the basics that people will tell you, people like Warren Buffett. By the end of his life, Claude Shannon sounds a lot more like Warren Buffett, than a kind of active trader. He has one thing that he does do, which is he imagines a scenario that challenges what's sort of called the kind of random walk on Wall Street, right? He challenges the view that there's no way to make money off of the fluctuations in a stock, right? And so what he does is he sort of describes how if a price goes kind of up and down, you can actually, through a strategy of kind of creative rebalancing of your portfolio, make money from that. And then he kind of charts it out. Now, ironically, once he finishes this long lecture, everyone's paying attention. Someone asks him, well, do you use this strategy in your own investments? And his response is, no, the commissions would kill you. And so it's what he basically shows is that you can use this rebalanced portfolio to create less volatility than the volatility of the stock, and therefore give yourself a higher return over time, and including a sort of higher risk-adjusted return too. And so he does that, but then his actual investing strategy, when he and his wife are thinking about investing in KFC, they have a bunch of friends over and they buy a bunch of buckets of chicken and they eat the chicken to see if they like it. And that's what he's thinking about. He's not plotting out crazy curves and studying dips and all the rest. But he does make an attempt to kind of harvest this volatility to see if you can do anything with it. And his theories now, from what I can gather, would be what people sort of call a kind of constant proportion rebalanced portfolio. And the idea that you can rebalance between your cash and your investments in a way that enables you to take advantage of some volatility. There are people who have done later work on this. It's one of those classic cases where Shannon's unpublished work, if he had taken it a few steps further, probably would have given these people the insights they had later. There have been market theorists that have played around with this, and economists who have played around with this later, but that's what he was playing around with, was portfolio rebalancing as a way to basically deal with volatility.
Yeah, I mean, you've got to think, like, when he was giving this lecture at, I think it was MIT, you mentioned, about this particular strategy, which worked, except for when you factored in commissions. I mean, commissions back then were extremely high. I mean, now you can get them, I mean, commissions are very dirt cheap, so it's possible there's probably some merit to what he was saying. I mean, is that research of his, can you find that anywhere?
Well, so you can find part of it, some of it in our book. We're actually going to publish, and I'll share the link with you once it's live. We're going to publish a longer piece on some of his market theories and some of his trading theories. But no, it's actually, one of the things about Shannon is he had so much work that he did that he just never published. And this stuff is buried in the Library of Congress. We went through 21 boxes of papers at the Library of Congress. And this is just a handful of notes from that lecture, an interview he gave with a couple people about it. But honestly, it's not there. And the truth is, like, he himself acknowledged that part of what was happening was he was modeling a stock which would lose half its value on the first day, regain its value the second day, then flip and reverse. And he was making money off of those changes, but those are hard things to predict. So there were some assumptions baked into his model that I'm not sure reflect kind of how the market actually operates. In addition to the question about commissions, I will say it was at the time, people believed the idea of the random walk on Wall Street. They didn't think you could make money off of volatility. And I think a lot of what we've seen in our time is, let's say, how do we put this generously? People take advantage of volatility using things like high frequency trading. But Shannon there was some thought there that you could actually challenge the conventional view. So even in this, he was unwilling to kind of accept what was the norm, to say, okay, what if we could find a way to take people's cash as soon as the stock value went down, pour the right balance back in, and he managed to at least plot out the idea that you could make some money doing this. But no, it's not an easily accessible thing. We have a little bit about it in our books, and we have a little bit about it. It's investing in our books, and we're going to plan to publish a nice piece on it to dive into it a little bit more deeply. I think the thing again to know is that, like, at the end of the day, the theory was what the theory was. What he was a good fundamentalist.
So did he become wealthy through his investments in the stock market, or did he build a lot of his wealth through other things which he'd done in his life?
He did become wealthy through the investments. And there are, some of this is legend, some of it is true, some of it is just exaggeration, but they made some, part of what happened was that, I think over time, their portfolio achieved a compound interest of 24% over that period, which is significant. And part of that, though, was that it was basically 3 stocks that accounted, and they managed to get it on the ground floor. The stocks would grow, companies would get acquired, the values would shoot up, they would hold on for the ride. And so he had wealth. It was paper wealth. So they could have sold, they could have done some things, but he was more than happy, as he put it, he said, I'm willing to borrow on our investments if necessary, rather than sell our stocks and convert them to interest-bearing instruments, right? And so he was more than happy, for a variety of tax and other reasons, to just use that. The Shannons were also not very lavish people. They purchased a nice home in a kind of community 8 miles north of MIT, lived out their days, and they weren't flashy people, so they didn't necessarily need all of this wealth that they had accrued. But they had done pretty well through their investments, particularly in Teledyne. They had an investment in Motorola, and in their notes, in those 21 pages, there's a table that he printed out of the stocks that he owned, and it has a few columns: how many shares, the purchase price, and what the price was in 1981 when he makes this table. And so, for example, with Motorola, he buys these shares at $1.13, and when he's looking at the price in 1981, it's $65. He gets Teledyne for $1, and in 1981, it's at $194. And so he's managing to kind of place these bets and get in early, but the most important thing he does is hold on, and it does give him some wealth toward the later part of his life.
Okay, right. And that 21 pages, which has this printout of his stock holdings, whereabouts can we find that?
Oh, I'm sorry, I wasn't clear. So the Library of Congress has 21 boxes of his papers,
okay.
and the printout is actually just one of the pages in that 21 boxes, and it's actually kind of amazing. They were early subscribers to a stock price service, like a ticker service, and they printed this out on an Apple II, like one of the earliest Apple IIs, which was actually hand assembled by Steve Jobs, and so they have access to all these like early technologies. They use it to print out things like stock quotes. And so there are all these like pieces of paper with stock quotes floating around the house, which is what his daughter told us. I think it's one of these things. If we just take a step back to bring the conversation around full circle, the stock market wasn't an end in itself for Shannon. He wasn't, like I said, he wasn't a flashy guy. There were stories of these kind of uncashed checks that he had. He like left money sitting in a checking account that didn't bear any interest or do anything. Money was a game. It was a puzzle. It was like, how do I come to understand the market? What can I use to understand the market? So he actually builds a machine that simulates money going in and out of the market. So he does all these things that are just amusing to him. And the market is not this kind of, it's a serious thing, and as much as he's playing with live ammunition, but it is also just a way for him to have fun and to sort of talk about things he enjoys. And so that's kind of how I tend to think about it, is that this is just another puzzle for him to understand.
Right, yeah. Like you said, he likes the challenge of it and likes the problem-solving aspect.
You know, and another thing that he did, which was really probably the smartest thing he did, is anytime they'd make an investment, they would either try to dive very deeply into the product, like in the case of KFC and eating it, or they would try to meet the founders. So they always made an effort to use his sort of stature within the scientific community to get meetings with founders to see if they liked them, to sort of kind of understand what made them tick. And that's part of what drives a lot of their investing, is actually meeting these people in person, shaking their hands, getting to know them, and then making investments. And, you know, to the extent that like he cares about how a company is going to do, their metrics weren't complicated algorithms. Their metrics were, what is the product like and what's the leadership like? Yeah,
very much like a value investing sort of approach, isn't it?
Well, and they held on to the stocks for 20 plus, 30 plus years. So yeah, it's exactly, I mean, it is very much like a value investing approach. And there are some estimates that show that their portfolio, skewed though it was one of the best performing portfolios, of their day, just because they would get in, they would hold on. He bought. This is like one of those that always makes you jealous. He got Hewlett Packard because he was involved in this company, Harrison Technologies, which was acquired by HP. So he gets HP at 13 cents. And in 1981, it's at $82. And I'm just like, oh my God, that's unbelievable. What a return. And so the appreciation was pretty significant, but it's partly just because they would get in and then hold on.
Yeah. Wow. All right, Jimmy, well, let's do one last question. I'd just like to ask you, as you know, Claude Shannon is a brilliant mind. Was there anything he did in particular to try and keep a sharp mind, or to help good thoughts, or anything like that? Like, did he have any sort of strange sleeping patterns? Did he have a strange diet? Did he have a big focus on meditation and exercise? Like, was there anything like that which he did to keep his mind active? And I think you know what I'm getting at.
Yeah, absolutely. Like, what was his sort of Tim Ferriss secret?
Exactly, yeah.
You know, it's a great question, and I wrote a long piece with Rob on Medium called sort of 10,000 Hours with Claude Shannon, which is where we wrote kind of what we learned about him, kind of like what are the habits that you can pick apart from this genius. If I had to say one thing that I think stands out, it's that he was spending a lot of time later, particularly later in life, taking things apart and putting them back together and trying to improve upon them. And so a good example is even when he's in the nursing home and he's suffering from Alzheimer's, is a very hard time in his life and the family's life. He actually a report has it that he took apart his walker and tried to like reconstruct it and see if he could make it work a little bit better. Right. And I think based on, there's a couple books about this concept, that the idea that like working with your hands can help you cognitively. One is Shop Classes, Soulcraft by an author named Matthew Crawford. But I really took that to heart from doing the research on this book, which is there's something really powerful about working with your hands and building things and then kind of taking things apart and trying to rebuild them and put them back together. And I think like there was an era in which, people would tinker on their cars. And like now, God, if I try to work on my car, I'd ruin it, right? The same way that if I try to open up my Mac laptop, I'd wreck it somehow, right? And we have all these devices that are very clean and very polished and very intuitive, but I wonder if we're not missing something from that there's not value in kind of the shop class, like in building things, because I do think that cognitively it places different demands on you. In that book, Matthew Crawford talks about how he has this line, and I'm not going to get it exactly right, but it's something like, he's like, I did more hard thinking in an afternoon working on motorcycles than I did in 4 years of getting a philosophy degree, right? And I think we have this tendency to sort of poo-poo the manual trades or sort of look down on working with your hands as something that's, for other people. I think that for Claude Shannon, working with his hands is partly what led to his brilliance. And I think it kept him cognitively sharp. I think it placed demands on his brain to think about how machines were built that led to a lot of the theoretical mathematics that he did. And so I do think that, like, I look back and I say to myself, like, how am I going to incorporate that in my life? And I do think that, there's something to that, even if we can't quite pin down what it is.
Sure. Yeah, that's a brilliant answer, man. That's very good. And I just want to mention also that article that you wrote on Medium is very well written, and I'd really encourage everyone listening to this to read that also. So I'll put a link to that in the show notes on the website.
Thank you. I appreciate that. It was one of these things, like, you do. We write in the article, you kind of live with these people, like they become your roommates essentially for 5 years. So we had this weird tinkering genius mathematician who was sort of kept to his own as a roommate for 5 years. And we like to think some of that stuff rubs off and you pick things up. And this article hopefully is for people who don't know him, hopefully this article is a good introduction to who he was.
Absolutely. No, I'm sure it will be. So, Jimmy, let me say thank you very much for coming on the podcast. If anyone wants to find out more about the book or pick up a copy, it's called A Mind at Play, and I'll set up a link, chatwithtraders.com/Shannon, and that'll take you directly to the book on Amazon, so you can find out much more about it there. Jimmy, you're also on Twitter as well. What's your Twitter handle?
Yeah, I'm just at Jimmy A. Sony at Twitter, and would love to hear from your listeners and your audience. I'm happy to talk about Shannon, all day long, and hopefully what I'm going to try to do too, just to open the kimono a little on research, is we're just going to start putting stuff out there. We put up a document that he wrote called Creative Thinking, which you can also find on Medium under my name, and it's essentially like a speech he gave on how to think more creatively. So we'll start putting that stuff out there, and the stock market stuff. And I really appreciate the chance that you've given to share this with your audience. I think his story is amazing. I think a lot of people can learn a lot from it. So thank you for taking the time to do this.
Pleasure is all mine. This was a lot of fun. Do you just want to spell out your Twitter handle?
Yeah. JIMMYASONI.
Good stuff, man. Once again, I really appreciate you doing the podcast. Like I said, it was a lot of fun. So yeah, thanks very much.
Thank you, Aaron. I really appreciate it.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Every decade, the market reinvents itself. Online brokers opened the doors. Mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool. Limited risk trading. From now on, your trading risk is capped and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade large positions and scale your strategies without risking your own savings. It's time to trade with more capital, actually worth more of your time and effort. Ready to trade the pool? Click the link in the description and join Stock Trading Revolution today. Doesn't your portfolio deserve the best? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Trade smarter with advanced charting tools, backtesting, a pre-built strategy selector, and more features. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involve involve risks and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey, what's up? What's going on, everyone? Now, this is the first intro I'm recording since getting back from Sydney last week. So I'm back in Brisbane now after a fairly short, but a very busy few days in Sydney. Yeah, so while I was down there, I hosted a live podcast, which you probably heard me hyping up on the past few episodes. But anyway, that's all over and done with now. And I would like to give a big shout out to everyone who came along and attended. The evening was a lot of fun. It was a sellout event. I think we had about something like 160 people there, many of which were professional traders. There were several past guests from the podcast. There was a few brokers in the room. There was even some of the higher ups from a couple of the prop firms in Sydney. All in all, it was just a really great group of people. So thanks everyone for coming out. Of course, a thank you to Trading Technologies for getting behind and supporting the event. And a big thank you to WeWork for allowing us to use their space and drink a lot of their beer. All right. Now, let me tell you about what's coming up on this episode. My featured guest is hedge fund manager Eric Townsend. So I'm sure some of you will already be quite familiar with Eric, in particular the macro investing crowd, because Eric hosts the Macro Voices podcast. That's right, Eric is a budding podcaster. Eric has a pretty interesting story and some interesting experiences about what's led him to where he is now. You'll hear all about this in just a moment. But other big talking points we cross off include how Eric uses the concept of the fourth turning and major cycles to guide his macro outlook, and one possible scenario for the future of cryptocurrencies. I'm sure some of you won't like what you hear, but I think it's well worth listening to. You know, macro's not really my thing, as I expressed a couple weeks ago, but to be honest, I found this conversation with Eric to be really fascinating. So I hope you'll agree with me and get something out of this also. In case you are wondering, this conversation was recorded on the 17th of August, 2017. All right, well, I'm going to end this right here. Here is my guest, Eric Townsend, for episode 141.
Microphone is good. And 1, 2, 3, Mark, I'm rolling.
Okay, cool. Anyway, Eric, what were you doing before you got into trading? Let's hear a little bit about that.
Well, I was an entrepreneur in the software business. I spent most of my career designing distributed software systems. If there's any IT geeks in the audience, the idea that's now known as this is funny. I almost forgot what it's now known as, service-oriented architecture. And it wasn't called that when I started doing it in the 1980s, but I'm one of the guys that co-invented that idea. And I've never been credited as the guy who invented that idea, but we were doing it before anybody else. And I actually sold the company in 98 before, I think it was Gartman Group, coined that term. But it's basically getting figuring out how to get a bunch of large enterprise information systems talking to one another and communicating with each other. And I sold that business in 98 because it was obvious to me that tech was in a bubble. And so I come from that background, and what I thought I wanted to do in life was to learn to run my own money, because I'd always been fascinated with investing and finance. I watched Wall Street Week with Louis Rukeyser when I was a kid in high school, and I thought that's what I wanted to do. And very much to my regret as I look back on it, it was the M&A lawyer that handled the acquisition of my software company that talked me out of it. And he just said, Eric, you are a software guy. You're not a finance guy. You've got millions of dollars now. You are not qualified to manage your own money, and it would be reckless and irresponsible of you to try to do so. You are at a wealth level where you can attract the services of the world's most prestigious investment bank and have their private client group manage your money. You should do that. Don't try to do this yourself. You need professionals. That is the single worst advice that anybody has ever received, I think. And, as I look back at it, the part of that he was right about is I was not qualified to run my own money at that time. I was a software guy. I didn't know a lot about investing, and I would have needed to invest in learning. That's what I should have done. Instead, I got talked out of it. So I went off and lived on a yacht and tried to be retired in my early 30s, which never works, and wasted what really was the worst chapter of my life. Believe it or not, living on a mega yacht, 87-foot motor yacht, touring around the Caribbean is the worst experience that I've ever had in my life. I was bored. I hated it. I thought that's what I was supposed to do because I had money, and it was miserable. And what happened was the world's most prestigious investment bank lost about half of my net worth in the course of 6 or 7 years. And out of necessity, I finally did what I should have done in 98, which is to learn about markets and do what I always wanted to do, which is to be a full-time private investor. And so that was probably the end of 2006, beginning of 2007, that I kind of reinvented myself as a full-time private investor. By then, I had sold the yacht and tried to figure out what I was going to do next in life. And I thought that what I wanted to do next was some kind of fintech business. I figure, okay, I'm a software entrepreneur. I know how to run a software company. There's a lot of opportunity in algorithmic trading and so forth. I must be some opportunity for me. I'll go do that. And what happened was I had a whole bunch of faulty assumptions about the investment business. I knew about Graham and Dodd's style of, analyze balance sheets, figure out, expense ratios, and decide which company to buy in a buy and hold stock portfolio. I knew about that stuff, and it didn't sound fun to me. And when I think it was probably reading Jim Rogers' work that really got my attention, I said, wait a minute, learning about macro, learning about what the interactions are between governments and trends and global trends in the economy, learning all these fascinating things. Why is it that when there's an earthquake in Chile, the price of copper is likely to go up? Or what if this Ketla volcano in Iceland erupts? What's downwind of that? How many people spend time thinking about that? Well, the Russian wheat crop is downwind of that. So as I figured out that you can learn about the most fascinating and interesting puzzle in the history of the world, which is how all of the global macroeconomic connections relate to one another and how currencies, currency exchange rates relate to the relative productivity and interest rates that are being offered in different countries and so forth. You can actually learn about all these fascinating things and make money by knowing about this stuff. And that's called macro. And I didn't know that existed. So as I was researching what kind of fintech software company I might launch, leveraging my software experience, I learned about macro and I just fell in love with it. And so I invented myself or reinvented myself as a full-time private investor, tried to learn as much as I possibly could. And eventually I got pretty good at it. I'm a very collaborative kind of guy. So when I was living full-time in Hong Kong, I established a traders group, and we had a bunch of mostly hedge fund guys that got together every couple of weeks. We rented the Chamber of Commerce, Canadian Chamber of Commerce in Hong Kong, and basically just had a traders lunch meeting every couple of weeks. And these guys I got to know said, Eric, we've met private investors in air quotes before, guys that take their iPhone to the golf course with them and check their stock quotes. You're sitting in front of 9 computer monitors and you're there for 14 hours a day. You're doing all of the work of, running a hedge fund except for calling a lawyer and turning it into a hedge fund. You should do that. And I said, what are you, crazy? I'm not in this business. I'm a software guy. And they said, well, look, you're doing this. And I resisted that advice for several years because I didn't really want to be in the finance business. I hadn't had very good experiences with the world's most prestigious investment bank and their very elite private client group that lost half of my net worth. So I didn't want anything to do with it. And it was really not till 2013 that I finally launched a fund. And it's fascinating to me that it went down this way. The business about making lots of money, running other people's money and making lots of fees on it. You know, I'm a small guy. I don't have the ability to raise institutional capital. It never really made sense from a fee standpoint. But what's happened for me is I'm running a business again. When I was a private investor, I was not engaged. I wasn't waking up and feeling like I've got a mission in life. And what's happened is my trading returns have improved dramatically because I've got a mission. So I don't really have very many investors in my fund. I'm mostly running my own money, but I'm better at it now and I'm much more committed to it now that it's organized this way. So it's kind of a weird story, but that got me to this point of basically running my own money, but it's organized now as a fund and it's been fun. I've met some interesting people and have learned about all sorts of things that I never knew about before. So it's been a real journey for me.
It certainly sounds like a real journey, and there's a few interesting things which you've mentioned, and I'd love if we could go into them a little further. One of those being the fact that you said that you'd retired from the software business, at least by when you were 30-something. You had millions of dollars in the bank, and you were in the Caribbean living on a great big yacht. I mean, for many people, that sounds like the dream. I mean, why was that not the dream for you? Why was that not the best time of your life?
Well, I certainly thought it was going to be the dream. It sounded like the dream to me. What happens is this. Everybody who's interesting, everybody who is intellectually engaging has a job. I mean, I guess there's 80-year-olds that are interesting and retired and don't have a job. But anybody in my age, I retired when I was 33. Anybody in my age group who was interesting is at work. And the people, you know, a yacht especially, it's not something you can enjoy by yourself. It's a group activity. Now, there's every imaginable kind of scumbag, sleazeball, and, parasite that wants to hang out with the guy that has the yacht. So there's no shortage of people in your life, but they're all the wrong people. And all the right people are busy because they've got jobs, they've got careers, they're doing interesting, intellectually stimulating things. And I found that I went from having a career in the software business where I had about 40 people working for me, all of them six-figure income, very, very smart people. My interactions every day were dealing with the smartest people on earth because my whole strategy in the software business was basically every time I meet somebody smarter than me, just figure out how to hire them. And that was what led to my success. And I was surrounded by very smart people. And now all of a sudden I'm a multimillionaire. And the only people that I know, the personal network that I have, are waiters and bartenders in restaurants because I eat out a lot and I don't know anybody who's interesting anymore. And, you know, is amazing as a Caribbean beach and a scene on a yacht seems like it ought to be, it gets old fast. And the food sucks in the Caribbean. The responsibility of running the boat is very serious. You know, hurricanes and stuff, you got to constantly move the boat around. And as much as it looks like fun, it's not. And so I very quickly tired of that. It also takes a lot longer to sell these things than it does to buy them. And so getting rid of the yacht was probably the best thing that ever happened in my life. And it was from there that I wasn't sure what I was going to do next. And I thought I would get back into entrepreneurship as a software guy because it seemed like the natural thing. And it was really discovering macro that changed my life.
So while you were living on this yacht, that was the point where you had put some of your money with this prestigious firm, which you've spoken about, and they were managing your money, right?
Oh, and it was just I got so completely screwed over by these people. The worst advice that I've ever gotten was this lawyer who told me you cannot go wrong having the world's most prestigious investment bank run your money for you. Look, what the big investment banks are good at is making money for themselves and ripping off their clients along the way. And what they did is they saw me coming. They basically, told me, you're the kind of guy at your age, you can afford to take some risk. You ought to really invest in private equity, because they were supposedly the best of the best at private equity. And they recommended that I should put about 2/3 of my net worth into a single fund of funds, a private equity fund of funds that this outfit was offering, and it would invest in some of their own deals as well as other managers. And what that really means is it was the highest fee structure product they could think of to sell me. And at that point, I was not an investment professional by any stretch of the imagination, but I knew the basics. I said, wait a minute, put 2/3 of my money into just one investment? What about diversification? They said, oh, well, it's inherently diversified because it's a fund of funds and it invests in a whole basket of different sub-investments, and it's diversified. Well, of course, that's nonsense. It's all private equity. It's all the same asset class. It made no sense whatsoever. But most importantly, private equity is structured as a long-term, it's a 10-year limited partnership agreement, and you can't get out of the thing. So I had a $10 million commitment to this thing, and at the time that I agreed to that, which was a mistake, I had a little over $15 million in total investments. And, 2000 hit, and the stock market took a dive, and all of a sudden $15 million turned into $13 million, and I'm immediately on the phone calling my private banker, the esteemed Harvard MBA private banker that knew everything. And I said, hey, I'm getting concerned. I've got this huge commitment of $10 million that I forfeit the money if I miss the capital calls. The $15 million turned into $13 million. Should we go to cash? Should we reduce exposure? What should we do? He says, oh, no, you want to stay with the investment. Don't make the mistake of panicking and getting out on a bottom. You want to keep all of your money invested. Well, what that really meant is they want all of my money invested in their high fee structure S&P type of fund, which is basically an index fund with a very high fee structure. And all of a sudden, a couple months go by, I get another statement, and the 13 million is turned into 12 million and then 11 million. I'm calling them up in a panic saying, hey, guys, we're down to just barely over what I'm committed to in this investment that hadn't really started yet, because I agreed to this at the beginning of 99, and it was a 10-year limited partnership where over the course of those 10 years, you get all of these capital calls and have to, put $10 million into the thing. And they said, no, don't worry, because, sure, you're only at 11 million right now, but, that'll turn around. And more importantly, these things, they never really draw down all of the money until they start distributing. There's an overlap there. You're not going to have the full 10 million drawn down at the same time. You've got absolutely nothing to worry about, were the words that they told me. And I said, boy, this does not feel good to me, but they're the experts. My lawyer told me I cannot go wrong with the world's most prestigious investment bank. Well, another year or so goes by, and they call me up one day and say, hey, you don't have enough money in your account to cover this capital call. What do you want to do? I said, what do you mean? What do I want to do? You're running my money on a discretionary basis. I agreed to let you guys do this because my lawyer talked me out of doing it myself. I never would have gotten into this. I've called you 5 times and said, why are we not going to cash with my remaining investments so that we have enough money to fund this? You told me, quote, you have absolutely nothing to worry about. And my private banker, the Harvard MBA, said, oh, well, we don't have that in our notes. And one thing these people are very good at is they keep very, very detailed notes that may or may not reflect what really happened in the conversation. But they're very well equipped to defend themselves in a lawsuit. So, who knows what their notes said, but it did not reflect the actual reality. And they're basically saying, this is your problem. And so now all of a sudden, fire sale the yacht. I wanted to get rid of the yacht anyway. I'm, gone from supposedly being comfortably retired and set for life to scrambling to sell off assets to meet capital calls. And I was forced to sell 20% of that $10 million commitment at pennies on the dollar because it was the only way to meet the capital calls, and took a huge loss on that. There was absolutely no reason to have gotten into this investment in the first place. I knew better. Shame on me for having been talked into it. As my available assets that were still liquid were decaying, I knew, and I called them over and over again and said, hey, guys, but I stuck for some reason. The fact that the guy was a very expensive M&A lawyer seemed to be so sure that he'd seen so many entrepreneurs make the mistake of trying to run their own money. And he was so convinced it was a bad idea that I should let the professionals do it, that I trusted their judgment. And eventually it ended up costing me about half of my net worth. And the other thing that was amazing, it's a 10-year private equity fund from 1999 to 2009. That's 10 years. Well, as of this day in 2017, I still haven't gotten all my money back out of this stupid thing because as a result, supposedly, of 2009, which admittedly was not a good time to be liquidating that kind of investment, they extended the 10 years. I didn't see in the fine print that they don't really have to give the money back when the 10 years is up. And maybe that made sense for a couple of years, but they tried to just stretch it as far as they could to make more fees out of it. And to this day, it is still not fully closed out. And I didn't make anything, especially after having to liquidate 20% of it at pennies on the dollar. The whole pitch that I had gotten was supposedly they were anticipating a 21% annualized return, and supposedly never in the 150-year history of the world's most prestigious investment bank had they ever underperformed their estimated returns for one of their special investments. And well, they certainly did in this case. So, my message to anyone is, if someone is telling you shouldn't be running your own money because you're not qualified to do it, they're probably right. You're probably not qualified, but you're better off learning to do it and qualifying yourself than trusting the private wealth management business. Certainly the private wealth management business of the major investment banks. I think that the good guys in the private wealth business are running smaller shops. They're not the big investment banks.
Yeah, that's an interesting comment, and I can only imagine how frustrating that must have been for you. I mean, I can't believe you still don't have all your money out of that, considering you first entered into the arrangement in 99. I mean, you're not wrong. They certainly are trying to drag that out. It's an interesting comment you make because, you've taken responsibility for your own money now and you are managing your net worth yourself. You're also taking it very seriously. Like, this has become your full-time job now. For someone else who might not want to make it their full-time job, but would like to do something, let's say they have a bit of cash in the bank and they'd like to do something with that instead of having it just sit there. I don't really know how to best word this question, but what do you suggest in that situation where someone wants to do something, but they're maybe not prepared to make it their full-time job? Is that still a viable thing to do?
It is viable, but I think that the immutable rule is what I call the Schwager doctrine. And I call it that for just Jack Schwager, who's written a lot about it in his books, which is you've got to find your passion. You cannot do this investing stuff as a job you don't like, but you've got to do it for money because you will fail at it. You've got to figure out what makes you passionate. And, if you're the Graham and Dodd style guy that's just turned on by balance sheet ratios, good for you. I couldn't do it all day. If I tried to, I would fail at it. Figuring out macro, understanding the interactions between nations and what makes the world tick is so fascinating to me that I just can't get enough of it. And there are certain themes, which we can talk about if you want, that really have captivated my attention. And those major themes that have to do with what the world is going to be like and how the rest of what I expect to occur in the world for the rest of my lifetime is so fascinating to me that I don't do this because I need to make the money. I've gotten back to where I started, where I'm comfortable enough to be retired, and I've got enough money to get back to where I was before I met the Harvard MBA at the world's most prestigious investment bank in 1998. So I don't have to do this. I do it because it is so much more fun than living on a mega yacht in the Caribbean. It is so interesting to just be on top of markets and to see what's going on, and particularly to see how this fourth turning is playing out. I just interviewed Neil Howe myself last week, the author of the book, The Fourth Turning, which is one of my favorite investing books of all time. And it is so interesting to me just to wake up every day and think about where we are at this moment in history and what's coming next. You've got to figure out what you're passionate about. And I don't think it makes sense, regardless of whether you've got millions of dollars or hundreds of dollars, it doesn't make sense to risk it on something that you're not committed to, that you can't do with passion, so that you are just attracted to it for the sake of doing it, regardless of making money at it.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too small to matter? Good news. With Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, and even the newest IPOs. And short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. It's a game changer. Create your account and start trading real shares within minutes. No subscriptions, no minimum deposits, just a one-time evaluation fee starting at $47. That's it. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you ever pay a cent. Every decade, the market reinvents itself, from online brokers to commission-free trading. Now, the new era of limited risk trading has begun. Click the link in the description to start trading with Trade the Pool's capital.
Okay, now we're going to speak about the fourth turning very shortly, but just before we get into that sort of thing, I feel as though I really need to ask you, how did you begin to come to grips with understanding macro? How did you start learning about this stuff? Because, you were a software guy, you retired from that business, you kind of took a hiatus for a while, and then you've decided that you're going to get into managing your own money. The macro approach has really appealed to you. How did you actually start learning how to implement and properly do the research and that sort of thing, which is involved with global macro trading?
I think that reading Jack Schwager's Market Wizards books was probably a turning point. I had for a while been trying to figure it out. And remember, at first, the mission I thought I was on was to go learn about the investment business so I could figure out what kind of software company I might start in the investment business, because I figured I'm a software entrepreneur. That's what I know. That's where my skill is. That's what I got to do next. And so I was going to finance conferences. I was going to institutional investor conferences, trying to learn about the business, figure out what a Bloomberg terminal is, one of the most mal-engineered software systems in the history of the world. Could I give them a run for their money? Well, it would take a lot of capital to do that, although there's plenty of opportunity. Bloomberg is a very, very poorly designed system from a technical technical standpoint, but they've definitely got the market captured. I didn't have enough capital to take them on. I'm thinking about the world in terms of a software company. So I start reading the Market Wizards books from the standpoint of thinking about, okay, I need to learn about different styles of investing so that I can see what needs to be automated with computers, what I could do using my skills. And I'm reading about different traders, different famous traders, thinking about what do they do manually that might be a ripe opportunity for automating with software systems in some way. That's how I started reading those books. And I think it was probably the Jim Rogers chapter in the first book that just captivated me. And it's, hearing Jim through Jack Schwager's interview talk about how he was a student of history and was just fascinated with the world. And that led him to, be successful, fantastically successful, just because he got interested in things like what happens if there's an earthquake in Chile? Why does that make the price of copper go up? That was so fascinating for me to read about that I was just enthralled with it. And I started thinking, well, maybe I should try to learn about that. And macro is something that I think that the downside to it is it's one of the hardest strategies. It's not something, if you want to do, momentum trading or, trend following or something. You can read a book like the Turtle book. I forget the name of the guy, Michael Koval or something. It's a 120-page book. You read the thing cover to cover and you know how to do the strategy that he embraces. Macro is really learning a whole lot about what makes the economy work. It's lots and lots of books about economics. I don't think it makes any sense for anybody to invest the time and energy to learn all about it unless, as was the case for me, every time you pick up the next book, you're so fascinated you can't put it down. And so I think it really is a question of finding what's that thing that resonates with your personality that says, this is what I got to do? And I don't know of any better way of finding that than reading all 4 of Jack Schwager's Market Wizards books. And I'd say the first read, if it's somebody who's new to this and they're not sure what they want to do, don't worry if you understand the details. You're reading about merger arb or something and you don't know what that means. It's not important. Listen to the style that each one of these traders that Jack interviews exhibits, how they describe the way they do things, and figure out what resonates with your personality. Once you figure that part out, and for me, it was guys like Jim Rogers that I really felt a connection to. And once you figured that out, then you start going and reading more about how to do that strategy and what's involved and so forth.
So essentially, a lot of what you know about macro today is being very much self-taught in some ways. Like, of course, you've got the information through books and doing your own research and that sort of thing, but it's not like you've had someone kind of holding your hand or guiding you through the things. A lot of it's kind of been very, self-discovered, right?
Yeah, it's self-discovered, and I think you've got to have an addiction to reading about it. I don't think anybody has enough energy to go read enough every day to be competent in macro unless they have some personal satisfaction from that reading. I couldn't possibly do what I do if it was a job that I was doing just because I make money at it. I do it because I can't wait to read the next article that teaches me something fascinating about the world that I never knew before. And there are aspects, to really take a classical definition of global macro. You've got to trade currencies. You've got to trade interest rate swaps. There's sort of a list of things that make up macro. I really give it a broader definition. To me, what macro means is understanding as much as I can about what makes the world work and what major trends are going to affect the future. So I get interested in things like fourth turnings and peak cheap oil and the international monetary system because I see that they're going to play a really important role in economic history in coming years. And that makes it fascinating for me. So, it probably is not the most strict interpretation interpretation of the phrase global macro, but frankly, I don't think anybody has a strict interpretation. The way to be successful in investing is figure out what you're good at and what relates to your personality or resonates for your personality and what you enjoy doing, because you've got to have, the only way you can have edge is to work harder at this than the next guy does. And the only way that you can, as far as I'm concerned, have the drive and determination to do that is if you truly find it enjoyable and rewarding and fascinating every step of the way.
Now, you've mentioned Fourth Turning a couple times. So Fourth Turning Capital Management, I believe that's the name of your fund, and I believe it's, of course, not just some arbitrary name. What's the significance of this? Would you mind just telling us a little bit about this concept of the fourth turning?
Sure. Well, I guess as I first started learning about long wave business cycles, and this was after I got interested in macro in general, I was reading about Nikolai Kondratiev, who was a Russian economist, who was, I think, the first guy to figure out that there's a long wave business cycle. A lot of people know about the 5 to 7 year business cycle that people talk about, where you kind of go through a boom and bust. Well, think about those as little waves on the ocean. Little waves are occurring on the surface of much larger swells, and the swells in this case are about an 80-year long wave cycle. And Kondratiev wrote a lot about it. This was, I don't know, it was 40 or 50 years ago, I think, that Kondratiev wrote about this. The guy that really modernized it is Neil Howe, who wrote the book The Fourth Turning, and it was actually co-written by Howe and William Strauss. Strauss is now deceased, so I think of it as Howe as the author just because he's the guy who's still alive. I had the pleasure of interviewing him recently. So essentially what he's figured out is that history comes in about 80-year cycle. That's the period of the wave. And those waves can be broken into roughly 4 different seasons. So think of it like seasons of the year. You know what a winter is like, you know what a summer is like, you know what a spring and a fall are like. History comes in these seasons that Howe calls turnings. And there are very clear patterns in American history as well as history of other countries that these seasons kind of drive everything. So there is, each one of them has a number and a name in Howe's book, but the one that we're in right now is called a fourth turning. And the fourth turnings are the crisis periods. The Spanish Revolution was one. The next one after that was the American Revolution. The next one after that was the Civil War. The next one after that was the Great Depression and World War II. The next one after that is the one that we're experiencing currently. And Howe wrote about how these things are all predictable. They happen about every 80 years. And a fourth turning is where you have the really difficult times where major institutions break down and get replaced. And that was the case of the pound sterling being defeated as the previous de facto world currency, being replaced after World War II with the U.S. dollar. Of course, the Great Depression, World War II were the major events of the last fourth turning. And then in second turnings, which are about 40 years off, that's when you have the major awakenings, which are cultural and spiritual. So in this current cycle, the last fourth turning was World War II and the Great Depression. The second turning would have been the 60s and, free love and the whole changing of social attitudes that occurred around the 60s and early 70s. Well, we're now, ever since 2008, which is when Howe figures that this present fourth turning started, they last about 22, 23 years. So this one will continue until about 2030. And this is the crisis period. And unfortunately, one of the things that we learn from studying history is that these things tend to start with something that seems like the big deal. So, for example, the last fourth turning started with the stock market crash and the Great Depression. And everybody said, well, yeah, fourth turnings are times when there's really bad stuff going on. We're having the Great Depression. That's really bad stuff. So we know what the bad stuff is for this fourth turning. Well, of course, what they didn't know at the time is that the Great Depression was the opening act and that actually World War II was yet to come. And that was going to be the really difficult experience that the world went through in the last fourth turning. And unfortunately, that probably means that the great financial crisis that began in 2008 was the opening act. That's the thing that's equivalent in this fourth turning to the role that the Great Depression played in the last fourth turning. That means that, World War II or its analog has yet to come yet. Now, I absolutely am not predicting World War III because I think that in this age of nuclear weapons, world war is pretty much an impossibility. If it does happen, it goes nuclear, civilization ends, and everybody's dead. So hopefully that doesn't happen. But I think that if you look at economic things that happened as a result of World War II, changing the world's, major hegemonic power was still Great Britain before World War II. Everybody thought that was forever. Everybody thought that the pound sterling was forever. These were things that were just ingrained in people's mindset that could not change. Well, of course, the Great War was such a big deal that it did change it. And you had Bretton Woods in 1944. And this is what happens the last couple of years of every fourth turning is there's a phase which Howe calls the resolution. And that's where old systems are torn down and new institutions are created. So at the end of the last fourth turning, which would have been around 1943 to 45, you had the creation of the World Bank and the IMF, United Nations, the Bretton Woods Conference establishing the U.S. dollar as the world's reserve currency. These are all the things that happen at the end of a fourth turning. So sometime in the late 2020s, coming into 2030, is when we should expect to see the new institutions being created that really define the economic backdrop going forward for the next 75 years or so. And I think that the U.S. dollar probably will be replaced. There's an economist called Robert Triffin who wrote quite extensively about what he called what's become known as Triffin's paradox or Triffin's dilemma, which is he said, look, how do you choose what's going to be the reserve currency? Well, you choose the best credit. What is the result of being the reserve currency? Well, the issuing nation is almost forced to run massive massive current account deficits in order to supply a sufficient quantity of the reserve currency to the rest of the world. So they're borrowing and spending beyond their means and getting away with it for decades. Eventually, that gets you to the point where you're not the world's best credit anymore. So look at the U.S. dollar. In 1944, the U.S. was a creditor nation. It had no external obligations. Now we are not only not a creditor nation, but we're the greatest debtor nation in the history of the world. This all has to come to a head at some point, Triffin predicted. And he said any country that becomes the issuer of the reserve currency will eventually lose that status because having that status causes you to do things that make your currency no longer suitable. So, if you look at all of the things that are likely to go on, if you have an understanding that where we are in history is in a fourth turning, we're only about halfway through it. It ends around 2030. And a lot of really major things will probably be reset and redefined by 2030. Well, what are the likely candidates? It's very easy to see. Is the U.S. dollar going to stay the world's reserve currency forever? Is the U.S. Treasury bond still going to be the safest investment on earth as it's perceived by almost everyone in institutional finance to be today? Probably not. If you look at the massive, massive debt that the United States Treasury has accumulated, we continue to get away with it because we're the reserve currency, and that creates such an external demand for U.S. dollars that there's something that was actually French finance minister at the time, later president of France, Valéry Giscard d'Estaing, said back in the 1960s, which is the U.S. has this exorbitant privilege, he called it. And the exorbitant privilege was referring to the U.S. having the ability to basically just borrow as much money as it wants and go into debt almost for free, because where other countries that were not reserve currency issuer would pay a penalty for that excessive borrowing. As reserve currency issuer, there's so much external demand for U.S. dollars, the U.S. could get away with it. Well, if we have been able to get away with $20 trillion of treasury debt without anything going broken in the night, and we get away with that because we are the reserve currency issuer, what happens when we're not the reserve currency issuer anymore? And at the same time, look at something like $200 and something trillion of unfunded liabilities in the form of Social Security and Medicare and so forth. We've been able to get away with having these systems that it's been known for 30 years that Social Security would go broke in the 2020s sometime. Well, of course, it's no coincidence that that is toward the end of a fourth turning. So at some point, if you look at the most important social contracts that we have in society, it's pensions and entitlement programs. We tell all of the hardworking people of the world, look, you've just got to work hard, pay your taxes, and don't worry, because there's this retirement system, a pension system, and don't worry, there's really smart finance guys like us who are in charge of it. And you can trust us, really. We're going to make sure that you're going to be able to enjoy your retirement and everything's going to be fine because you're going to be taken care of. But what's happened is because we don't think about demographics and the fact that there's this worldwide baby boom. It's biggest in the United States, but the baby boom exists in other countries around the world in roughly the same decades. We've got this huge demographic overhang of it used to be that all of these systems, there were far more people of working age paying into them than there were people of retirement age that were drawing down from them. We're going into a time frame right now. The baby boomers are hitting 70 and retiring. We're right now transitioning to where there will be more and more retiring baby boomers drawing down from Social Security and a smaller number of millennials who are paying into the system in order to finance it. So we've got these systems like Social Security and a lot of defined benefit pension systems that are basically Ponzi schemes. They have to fall apart. And those promises that have been made to all the hardworking people of the world that they were going to have all these defined benefits and everything's going to be great, those promises will be broken. There's no way around it. Well, what happens when those promises are broken? People are going to be pissed off. They're going to revolt. How is that going to happen? It will probably be violent in a lot of places. Eventually, sometime by about 2030, we've got to get through this as a civilization and figure out what we're going to do. Are we going to, super tax the people that are still working so we can take care of paying out the benefits to the people who are retiring? Are we going to tell the people who are retiring, hey, it was on your watch, guys, that, you might be 70 now, but you were 40 when the 60 Minutes TV show first broadcast the special about how Social Security was going to go broke by 2020. And you didn't do anything about it because you thought that was forever and you didn't have to be worried about. Well, now the piper has to be paid, and so you're not going to get your benefits. There's going to be huge, huge social divides. And you're already seeing it, with what's going on now in the United States, how the political left and right, which used to be able to air their differences and, go to a cocktail party and you could disagree with the guy who was in the other party, but you could still be civilized. Now we've got riots in Charlottesville and all these crazy things going on. It's going to get much worse. And the reason it's going to get worse is because these institutions like Social Security are not going to be able to make good on their commitments. Meanwhile, the Treasury debt is going to reach a point. For the last 3 presidents, we've had this plan of basically the United States in every presidential cycle over the course of 8 years doubles the national debt. You cannot exponentially double the national debt every 8 years indefinitely. Eventually, it blows up. When do these kinds of things blow up? History teaches us in the second half of a fourth turning, and that's the next 10 years. So it's going to be a really interesting ride. One of the things I want to just end this point on fourth turnings about that Howe emphasizes, it's not necessarily a bad thing. It's a necessary thing. It's going to be a really unpleasant ride for the world, I think, for the next 10 years. But this is how history takes major injustices like the fact that we've got way too much debt and that we have these unfunded systems and basically they all culminate together into a really big problem, and then it gets solved. And that solution paves the way for prosperity for the next several decades. So we're going to go through some really difficult things over the next 12 years. And eventually, hopefully, as we go into the 2030s, we will have solved our problems and we'll have a new era of prosperity ahead of us. But right now, we're in the home stretch for what's going to be some really hard times.
Wow.
Glad you asked.
Yeah, absolutely. So I have a few questions. Obviously, I've just been sitting here patiently. 80 years, where does that number come from? Like, why 80-year cycles?
The theory that Howe has, and I don't think Kondratiev had an answer. He came up with about the same number, and he didn't know why. Howe has the theory that it has to do with, it's basically a long human life cycle. And the idea is we learn from our mistakes. We also learn from our parents' mistakes because we saw them being made when we were kids. But we tend not to learn from our grandparents' mistakes because we were either not old enough or not around or whatever. And certainly our great-grandparents' mistakes, that's so far behind us that, we end up repeating all of those mistakes because we didn't learn anything. He has a theory that each generation, he has this idea that the seasons in the economy are really driven by generations of people, and that each generation has a personality. And he has archetypes that he defines. And he says, there's a prophet archetype, which is what the baby boomers fall into. And they have certain characteristics because they were, if you look at the baby boomers, they didn't live through World War II and the Great Depression. So each generation is defined by what it just missed. The baby boomers didn't go through all of that hardship, whereas the silent generation that came before them, they grew up during World War II and they knew what it was like. So I look at my father, who's of the silent generation. I think the guy is just so conservative. He was a little kid through the Great Depression. He saw what debt could do to people. He refused to go into debt, and for his entire life, he was just paranoid about having to save no matter what. The baby boomers, on the other hand, they were fortunate enough to miss the Great Depression and World War II. They never experienced that. All they remember is growing up in the American high in the 1950s and 60s and how great it was. So they're the ones that are much more inclined to go deep into debt because they haven't seen firsthand what can happen when you get over indebted, the way my father's generation has seen. The Generation Xers, they don't remember the American high and all the good times. They were, came up as kids through the 60s and 70s when the American family was falling apart. All of a sudden, kids were kind of bringing themselves up. You didn't have a nuclear family to anything close to the degree it existed in society previously. They learned to fend for themselves, so they were very much individualists. The millennials, on the other hand, were the overprotected kids. They were born in the 1980s when, the baby on board signs were in the back of the car and they had bicycle helmets and they were very, very protected by their parents. So they have this attitude of being very, comfortable with sharing with other people. They're very community oriented, whereas the Xers that came before them were much more individualist and were not nearly as comfortable with the so-called sharing economy that the millennials embrace. And then Howe goes on to describe another generation, which is just coming of age, which he calls the Homelanders. And they have the most in common with the silent generation, with my father's generation, because what they don't remember is anything that happened before 9/11 and the great financial crisis. Maybe if they were born in 2004 or something, they were around before the financial crisis, but they weren't old enough to remember it. And so their whole experience in life has been what the GFC and subsequent has been. So he basically says that the major events in history define the personality of these generations. And I just interviewed him on my podcast last week. So for anybody who's interested, there's a full hour-long interview with Neil Howe where he does a much better job than I do of explaining these concepts.
Okay, I can kind of see how that might make sense. One thing I'd like to put forward is the things which drove the markets, hundreds of years ago, Have they fundamentally changed from what drives the markets now, though? Like, wouldn't that throw off the 80-year cycle?
Well, I think it's a totally different game. A mistake you don't want to make is to say, oh, well, it was a Great Depression, financial crisis, followed by a world war, so that has to happen again. That's not the point of the fourth turning. The point is, this is the time when people lose faith in institutions, major institutions that were never questioned before, like the pound sterling being the reserve currency, or Great Britain being the world's largest hegemonic power. The idea that everybody assumes the United States will forever be the strongest military force on the planet and the strongest economy in the world, those are the size things that tend to change in fourth turnings. I don't know what's going to change. So it's not at all that the same stuff that happened last time will happen this time, but things of the same magnitude are likely to happen this time. The things that I look at specifically is really the whole pension crisis. What's going to happen demographically with entitlement programs and government pensions and so forth. You've got one set of problems in the United States. The welfare system in Europe exposes European governments to a huge amount of vulnerability. It's different in different places, but the same theme exists around the world. Another one that I look at a lot is energy, and a concept that I call peak cheap oil, which has to do with, where we're going to get energy in coming years. And, the world's not running out of oil. We're not going to not have any more. But what happens is you end up, the days of just drill a hole in the ground and oil comes out and it's simple, those are gone. We've already found and exploited those energy resources. Right now, shale is the big thing. At some point, shale will play out, and probably deep water will be the next thing after that. At some point, that'll play out, and who knows what's next, whether it's tar sands or deeper water or Arctic deep water, I don't know. But we'll go through waves of new technology being required in order to produce energy. And each new wave of technology comes at cost, and that means that the cost of energy in the economy becomes greater. At the same time, that's being offset with the advancement of technology because, you don't have to travel as much, and a lot of things can happen online, and a lot of collaborative technologies, video conferencing and so forth, reduces the necessity of business travel. So there's a lot of different trends that need to kind of be resolved as we go through this fourth turning and figure out what the next era is going to look like after this. So I think that it's not a question of the same thing happening. It's I think Mark Twain said, history doesn't repeat, but it rhymes. It's not at all that we're going to have the financial crisis followed by the World War. It's that we're going to have major institutions that people assume are never going to change do get changed, and they get changed in ways that nobody ever predicted, and it paves the way to a new form of society. The other thing that I do think is, again, just as every person has their own personality, every generation has its own personality. It's not going to be the same as last time. But what we do see is the individualism that I was brought up with. I was born in the 1960s, and, it's all about freedom and peace movements and so forth. And people were rejecting authority. What's happening now, probably because we're afraid of terrorism or whatever, is the new generation that's coming up, which Howe calls the Homelanders. They're very, very accepting of more government control, more authority. Millennials tend to be just as comfortable, if not more comfortable, with socialism than they are with capitalism. Whereas if you go back 40 or 50 years, if you even mentioned socialism in a favorable context in the McCarthyism era, you could get thrown in jail for that in the United States. These days, Bernie Sanders almost had the nomination for president, and a lot of millennials really think that socialism is a better system of government. So assumptions that we had on the level of whether or not a liberal democracy is the right way to run a government are subject to change. And I think that we're going to see a whole new world in the next 20 years. And at the same time, technology is advancing very quickly, and it's going to create a tremendous amount of investment opportunity. But I think what you've got to do is just be cognizant of where we are. One of the things that just, to me, is like the sound of fingernails scratching on a chalkboard is when somebody says to me, well, Eric, if you look at every post-war recession, I'm like, wait a minute. If your definition of economic history is what happened post-World War II, maybe that made sense before we got into this fourth turning. But you've got to start looking at a longer cycle of history, because assuming that history, everything changed after World War II and everything's going to stay the same as it's been since World War II. No, we're in the next major change where things that have been stable since World War II are going to start to change in ways that they haven't changed since before World War II. So don't think about every post-war recession. Think about what happened leading up to and going into 1929 and from World War I to World War II and what happened in that period of history. That kind of change, that magnitude of change is possible now. And it doesn't mean I can predict what's going to happen. It doesn't mean that what happened last time is going to happen this time. It just means that we're in for what could be some pretty big changes.
Now, as a trader, how do these cycles drive your investing decisions?
They don't directly drive trades, because if you think about something like, okay, it's a certainty that over the next 10 years, the demographic change is going to put huge pressure on the pension system. I guess you could translate that to a trading strategy, but I don't know how to make a profit next month on that. What it does for me, at least, is it causes me to focus on the things that I think are going to be important. So I've become extremely focused on crude oil because I see what's going to happen with this peak cheap oil phenomenon that I described earlier. Ironically, the fact that I'm definitely a peak cheap oil guy, I'm very, very fascinated by the theory of peak oil. It doesn't mean that I think oil prices are going up. I'm bearish on oil prices right now because what's happened is post the great financial crisis, we've had so much easy money in the system that it's led to a malinvestment of overproduction capacity in the shale patch in the United States. So it doesn't mean that maybe the thing you might logically assume is the long-term outcome is what you want to bet on. But the reason that I understand what's going on with the shale patch in the United States and why now is a good time to be actually, I think, bearish on crude oil prices, it's because I have this longer term view and this fascination with the big picture. Whether or not we're going to see another test of, sub $30 oil prices like we had a little over a year ago, I don't know. But if we do, it's going to be a buying opportunity of a lifetime, I think, especially if the longer dated futures contracts come down to a lower level. Last time we got to $26 oil, it was a little bit of an illusion because the long dated futures were still above $50. If we see long dated futures come below $40 or even below $30, it's going to be a fantastic long-term buying opportunity because I don't know what the next year or two is going to look like. But I can tell you as we get into the early 2020s, 2021, 2022, we are so not investing in capex right now in oil. Right now, we are oversupplied with shale. Well, shale is going to play out. There's only so many rock formations that are capable of producing this shale oil, and they have very rapid decline rates. So once all those shale oils get drilled and those resources are exploited and we start to go into deep decline, we're going to be hurting, and we're going to be hurting in a big way. Well, why do I know that that's coming? And it's really from the fourth turning concept where I get these big themes. As I learn in detail about those big themes, it oftentimes gives me a reverse trade. I'm right now I'm bearish on oil prices because of what I see going on in the energy markets now. How did I get so interested in the energy markets? Why do I pay so much attention to them? Because I can see that a really big move in the other direction is coming eventually. A similar analog to that would be something like the U.S. dollar. I have a view based on my long-term fourth turning view of where the world is headed, that the U.S. dollar will eventually lose its reserve currency status, and the U.S. Treasury market will be in really big trouble. So does that mean that I'm short the dollar and I'm in this dollar is going to crash camp? No, actually, right now, I think that we're probably looking at a buy the dip opportunity in the dollar. I'm not quite sure that it's over yet, but it's got to be pretty close. And I think the dollar is going to appreciate dramatically. Well, why do I think that? Isn't that opposite of what I just said my long-term view is? Well, it is opposite of the long-term view, but my long-term view causes me to get really fascinated with this and to understand that for now, there is no viable alternative to the U.S. Treasury bond market for central bank reserve assets. There's a lot of people around the world that want there to be one. Russia and China are working pretty hard to try to figure out how to create one, but it doesn't exist yet. And what that means is that as we come into some of these hard times that I see on the horizon, and we're very much overdue for a recession now. This bull market that we've had since 2009 is way long in the tooth. I don't know when it's coming, but you can't go forever without a recession. When we get to a recession and there's flight capital, there's so much structural problems in Europe and in Japan that distressed capital in Europe and Japan is going to experience a flight to safety trade. And I predict that it's going to push the US dollar into probably all-time highs. So, on the one hand, I have a long-term view that the US dollar will lose its reserve currency status, but I can also see that that cannot possibly happen right now. And what that means is that what will likely happen next is as we run into problems around the world, more and more flight capital will flow into U.S. dollars, appreciating the U.S. dollar to the point where it causes more problems in the global economy, probably another emerging markets crisis as we had in the late 90s. And that may lead to another Plaza Accord type of deal where governments agree to conspire to do what they can to suppress the dollar. And certainly President Trump has expressed a view that he wants to prevent the U.S. dollar from appreciating too much farther than it already had. So, these things don't necessarily mean that the trade right now is determined by the long-term view. But the long-term view is what tells me which markets are fascinating and which markets are most important to pay attention to. And then as I get into learning more and more about those markets, I develop where's the trading strategy. And so my macro view now is bullish U.S. dollars, although we've been in I was long U.S. dollar index futures. I've gotten out of that trade just because we've had this big downdraft. I'm not sure if it's over yet. At some point, I'll get back into long U.S. dollars. Someday I'll be long crude oil, but right now I'm short crude oil. So I learn about the markets that are most interesting from my long-term fourth turning view. But what I learn about them teaches me which way to place my bets. And that's something that is in a much shorter time cycle than the long-term view.
Got it. Okay. No, that makes sense. I see where you're coming from. Eric, I would like to speak with you about your views and your outlook on cryptocurrencies. So how do you feel about cryptocurrencies? How do you see them coming into play in the future?
Oh boy, well, we're in trouble now because I'm afraid I'm going to offend your cryptocurrency fans in the audience. So I've got to first preface this, Aaron, by saying this is not what I want, people. I have predictions about cryptocurrencies that you're not going to like, and I don't like it either, but it's what I think is going to happen. Everybody's so excited about whether it's Bitcoin or Ethereum or whatever, these wonderful innovations and inventions that technologists have come up with to say, look, here's a way to design a currency which is basically government interference proof. You can have secure payments online with Bitcoin. It's completely anonymous. Nobody knows who owns these Bitcoins. The government can't possibly manage it or track it or seize it or control it. And, as long as you have this ability to transact in Bitcoins, it all occurs online. It's anonymous and it's fantastic. It's great. I love those concepts. So please don't think, listeners, that I don't like the idea. I just don't think that it's going to be allowed to exist. And my prediction, unfortunately, I stress, unfortunately, I don't like this, is I think that governments are going to hijack all of the best technological innovations from the first generation cryptocurrencies like Bitcoin. So the whole blockchain idea, which is absolutely brilliant, from a software engineer's perspective. I mean, really genius level stuff that's going on there. I think it's going to be hijacked by governments to design a government-backed cryptocurrency that will have exactly the opposite set of design criteria, where Bitcoin is completely tamper-proof, and the government can't interfere with it. The government can't monitor your transactions and so forth. I think that governments, and I'm not sure which government, it'll probably be kind of an arms race between governments to see who can control this. But one of the potential ways that the U.S. dollar might be displaced as the world's reserve currency is by a government-backed cryptocurrency. And by the way, this is not just fantasy science fiction stuff. People's Bank of China is hiring blockchain engineers right now to work on the digital RMB and designing what it will be. And I don't know what it's going to be. What I fear is that some government is going to come up with a design for a cryptocurrency, which is the antithesis of Bitcoin. It guarantees that the government can always track and know exactly who has every penny of worth anywhere in the financial system. There is no cash. Cash gets outlawed. First generation cryptocurrencies like Bitcoin get outlawed. And furthermore, governments enact laws that say anybody caught having first generation cryptocurrencies, such as Bitcoins, will be subject to forfeiting them. You get caught with them, the government confiscates them, and you forfeit their value. That's the way governments do things. And unfortunately, what in this environment, in this social environment we're in, all that governments have to do is say, this is necessary to fight terrorism. Bitcoin is the tool of terrorists. It's a way to transact and finance terrorism internationally and anonymously. And the only people that would ever want to have anything to do with it are bad guys that are either terrorists or trying to finance terrorists. The good currency is the government-backed cryptocurrency, which stole all of its technical innovations from the Bitcoin and other first-generation cryptocurrencies. But what it does is it says in order to have a wallet, that wallet has to be registered with a government someplace, and any wallet that's not registered is subject to forfeiture, and the government knows exactly how much you've got, exactly when you got it, who you got it from, and they might even have the ability to claw back transactions. So imagine that news story that came out a couple of years ago where the guy in Texas sells his pickup truck to a car dealer, perfectly innocent transaction. It's got his plumbing, the guy was a plumber, and it's got the advertising for his plumbing business on the door of the pickup truck. Somehow, some way, that pickup truck finds its way to Iraq, and there is ISIS fighters with a machine gun mounted on the back of this thing, and they're going around and killing people with this guy's pickup truck. Imagine the government saying, okay, we want to punish ISIS. We're going to unwind that transaction. And now all of a sudden, the poor guy in Texas doesn't have the money in his bank account anymore because they've decided that pickup truck never should have been in the hands of ISIS fighters. Well, he didn't do anything wrong. My prediction is he would have to fight to get the money back because just the way the chargeback system works for anybody who's a MasterCard or Visa merchant, first the money is gone from your merchant account, and then you get to contest it and try to fight to get it back if you're willing to put the effort into doing it. So this whole business of IRS, having to chase you down and figure out where your offshore bank accounts are, they won't have to do it anymore. It'll all be online. They'll be able to seize your bank account, freeze your accounts with a click of a mouse, probably without a court order. I don't like any of this, folks, but if I think about what's likely to really happen, governments will figure out that Bitcoin is every bit as much of a threat to them as it was designed to be. And it was designed to be a threat to them. It was designed to give people the financial freedom and independence of not being subject to the overreach of government. Government doesn't see it as overreach. They see it as their calling, as their mission, as their duty. And they, in this social environment, can very easily get away with just about anything by saying it's necessary in order to fight terrorism, to outlaw Bitcoin, outlaw Ethereum, and instead have a cryptocurrency which is designed and built by governments for governments to give the government complete and total control over everything. And anybody who doesn't like it is automatically assumed to be a tax cheat or a terrorist or someone who wants to finance terrorists or something. I don't like any part of that story, but I think that is far more likely to play out in real life than this pipe dream that libertarians have, that, Bitcoin's going to change everything and everybody's going to go to Bitcoin and we'll be able to have all of this free commerce occur online and the government won't be able to tamper with or interfere or tax it. That's not going to happen. The government's going to outlaw this stuff because it's not in their interest. It's in the people's interest. Government doesn't do what's in the people's interest. Government does what's in the government's interest. And I fear that the best innovations of Bitcoin will be stolen and hijacked by governments to build something. I call this new cryptocurrency the Orwell, because that's really what it is.
Now, you obviously speak to a lot more macro traders than I do. Has anyone you've spoken to share a similar view on this subject?
On cryptocurrencies specifically, since I espoused that view on my podcast, I've heard from several people who are blockchain engineers who have said, we basically resigned ourselves to this idea at least a couple of years ago. A lot of people in the cryptocurrency space have a similar view, but they see it differently than I do. I fear that what I just described could be inevitable. The way that a lot of people in the cryptocurrency space see it is they say, okay, we know this is coming. We're going to have to think about competing. If the government introduces the official cryptocurrency, which is government backed, and they're telling people that only bad guys would ever want to deal with Bitcoin, how do we, if we're the Bitcoin side of this, position ourselves to compete? And they think of it in terms of, if you are selling the benefits, if it was a free choice of, do you want to you got to get out of US dollars because there's not going to be cash anymore. Are you going to get into Bitcoin, or are you going to get into the Orwell, which is what the government's telling you to get into? Here's why you should get into Bitcoin. So I think there are a lot of people in the cryptocurrency space who see the threat of a government-backed cryptocurrency that has all of these features that are designed to control and tax people, as opposed to features that are designed to protect people from excessive government control. They see it coming. They see it as a threat, but they're thinking about it in terms of how they compete with it. What I fear is they won't be able to compete with it because it will be just outlawed by government. And unfortunately, if you look at everything that's going on in society, when the government announces that something is bad and it's the tool of terrorists, it gets outlawed and very few people push back on it. So I think that if there is a chance to not have the Orwell take over as the government imposed cryptocurrency, it has to be through some kind of marketing campaign where the Bitcoins and Ethereums of the world sell the message to people that, look, we don't need the government to control our lives and to be able to tax everything. It's better to have free commerce. It's better to have a Bitcoin type of currency than an Orwell type of currency. I hope they can be successful enough, but you've got to win over enough people to overcome the government's ability to just outlaw the other currencies. I hope that they can succeed at doing that, but that's the place where I've heard about it from other people, is people in the cryptocurrency space thinking about how they're going to organize their messaging to sell the general public on the idea that a government-controlled cryptocurrency is a bad idea and a private cryptocurrency is the right thing.
Sounds pretty frightening.
It is frightening, and unfortunately, this is what happens with these cycles in history. Is the time, and you've got to be careful to. If there's any lesson I've learned, I was born in 1965. My generation was brought up in public school to think that our job was to question authority and to not let the government push us around and abuse our rights. That's not what they're teaching in grade school today. And you've got to understand, even if you feel, I'm 52, if you are my age and you feel like that would never happen because the people would never tolerate it. Well, wait a minute. You and I and the rest of our generation might not want to tolerate it, but younger generations are starting to be brought up to really believe that, socialism is better, greater government control. It's more important to do something about enforcing on and dealing with tax cheats and bringing people who cheat their taxes to account than it is to have financial freedom. That mindset is not something that resonates naturally to my generation, but we're not going to always be in charge. And there are other generations that feel very differently. So my message to anyone is don't just think about how you feel about these things. Talk to other people in other generations and how would they vote if the government is saying that in order to cope with tax cheats, in order to deal with these filthy rich 1%ers who are not paying their fair share, we've got to eliminate cash, eliminate first-generation cryptocurrencies like Bitcoin, outlaw them, and instead have a government-sponsored cryptocurrency which allows the government to make sure that those nasty 1%ers are not getting away with cheating on their taxes the way they have been for too long. You and I might say, wait a minute, that's BS. A lot of people would say, hey, that's welcome. Let's get the government going on that so that we can do something about those nasty 1%ers, whoever they are. And it's really not 1%ers. The true 1%ers, which are really about 1/10 of 1%, know how to game the system. They're going to be taken care of no matter what. In terms of economic freedom for the rest of us, I'm afraid that we're in a generational period where the government will likely be able to put an end to things like Bitcoin. Right now, it's not big enough to cause any problems, but I'm afraid that it's going to be outlawed eventually.
So when you talk about a government-backed cryptocurrency, are you talking about, just as an example, just the US government has like the equivalent of US dollars as a cryptocurrency, or are you talking about government-backed in the forms of like, I don't know, several countries involved in this, having one like maybe not global, but kind of universal?
Well, the prediction that I make about this is there's going to be an arms race. And if you think about the Cold War arms race, it's who can get control of space and who can get control of intercontinental ballistic missile capability and so on and so forth. Who can get it first. I think that the arms race will be between the private cryptocurrencies and government backed, and it will also be consortiums of multiple nations. I think that China and Russia are probably already working together on this because China and Russia have been working together on this de-dollarization idea that Sergei Glaziev, who's a Russian scholar and an advisor to Vladimir Putin, have espoused, that they need to try to use whatever influence they have to get people to stop transacting in U.S. dollars so that the U.S. stops having this exorbitant privilege of being able to go into debt for free. I think that the outcome is unknowable, but it just as the outcome of the arms race was unknowable. But there's going to be an arms race. It's going to be a realization, just as at some point somebody figured out, wait a minute, if you've got control of space, which means that you've got satellites in orbit that could drop a warhead on any spot any minute. You've got suddenly there's a space race, and supposedly it was about landing a man on the moon for the sake of humanity. It was really about let's develop space technology for military benefit, and both the U.S. and the Russians were doing it. I think that what people are going to figure out, both the private cryptocurrencies as well as governments around the world, is they're going to say, wait a minute, the U.S. dollar cannot go on forever. Robert Triffin was right in the 1960s when he said that eventually the U.S. dollar had to be displaced by something else as the world's reserve currency. At the same time, you've got a lot of pressure from governments around the world right now that they want to ban cash. And they want to ban cash for one reason, which is, not fighting terrorism and so forth. That's the one that sells well to the public. The one that they really want to ban cash for is it enables negative interest rates as a monetary policy tool. The reason for that is if you have cash, you try to go to deeply negative interest rates, it creates a financial incentive for people to hoard cash, which could cause a run on the fractional reserve banking system. You can overcome that problem by outlawing cash. So governments want to outlaw cash. They see this as the future. What's going to happen is, just as there was that aha moment where somebody said, wait a minute, whoever controls space is basically top dog military. They've got unlimited power over everybody else. They're going to say, wait a minute, whoever figures out the cryptocurrency that could replace the U.S. dollar as the world's reserve currency, whoever that is just in an incredible position of advantage. We've got to figure out how to make it be us. So I think that whether it's, the Ethereum people from a private cryptocurrency standpoint, or Russia and China working together. U.S. government seems to be slow to get to the game here, but eventually they'll figure it out. And they'll say, no, the U.S. dollar has to be the world's reserve currency forever. We just need to turn it into the digital dollar, which will have this new feature of being completely trackable for the sake of fighting terrorists and tax cheats, because those are the bad guys that the public will resonate with and want to help the government to fight. The fact that it's really to be able to monitor and control all of your financial transactions, they're not going to tell you that. But it has to be the U.S. dollar because, the U.S. dollar is the center of the world. This is going to be an arms race. And I think that you'll see competing technologies. The U.S. government looks like it's going to be slow to join the game in terms of trying to develop a government-sponsored cryptocurrency. They, at the same time, they have more money than anybody else. So once they figure out that they're late to the game, they'll probably spend a whole lot trying to develop it. The private cryptocurrencies are going to make the very good argument, the very valid argument, that it makes much more sense to put your faith in something like Bitcoin, which is mathematically safe. It's not controlled and governed by anybody. It's designed in a way with open source software where you can independently verify that it is safe, and it's a way to transact business that is immune from any government's interference. That if you're a libertarian, you're just loving that story. The thing is, libertarians are considered nut jobs by most of society. The idea that the government should be able to monitor and control everything for the greater good of humanity in order to fight terrorism and tax cheats, that resonates with the majority of the population. That's what they're going to vote for. And I think the private cryptocurrencies are going to do everything they can to educate people to see it a different way. I wouldn't be surprised if Russia and China, one of the angles I've thought about, I haven't really figured out the details, is Russia and China collectively have enough gold between them that they could do a government-sponsored cryptocurrency that differentiates itself from other cryptocurrencies by having some kind of gold backing behind it. So it's a combination of a gold-backed currency and a cryptocurrency that enables a cashless society and online transactions and so forth. Another question that you have to ask yourself is, suppose you're not the U.S. government, but you're one of the smaller governments, let's say Russia and China. Do you go down the whole path that I described of the Orwell, the currency which is totally controllable by governments? Or do you say, wait a minute, if we're Russia and China and we try to do that, the U.S. is going to do one that's probably going to beat us? What if we take if you can't beat them, join them approach? What if we partner with the Ethereum guys? And by the way, Putin already met with the Ethereum guys. So stuff's happening in this space. What if we partnered with them and it was government backed? And so that kind of gives it credibility. But rather than fight the private guys, at least for now, in the first generation, we'll go ahead and get on board with this privacy thing so we can sell it to the people who respond to that message, and we'll try to assert it that way. Are they going to do that, or are they going to go the approach of monitor and control everything for giving the government more control? I don't know. There's an argument that clearly governments always want control if they can get it. But if they perceive that government control is going to be an objection to whatever the U.S. comes up with, maybe what Russia and China do avoids that kind of control and looks more like Bitcoin in order to appeal to a different audience. At some point, I think before this fourth turning is over, by 2030, we're going to have a showdown, and we're going to get to figuring out what the cashless could even turn into a global currency, but the replacement for the U.S. dollar as reserve currency is going to look like. And I think it's a completely open game. The arms race has just begun.
Just to close this out here, can you actually speak about the real dangers of becoming a cashless society? Like, what are the implications of that?
Well, there's a lot of dangers. I mean, the first one is, the Orwellian reference. You're getting to a point where you could have abuses of human rights by governments, which is something that a lot of people don't worry too much about. I worry a lot about it. You definitely get to a problem that almost nobody thinks about anymore, which is, things break. We do have power outages. If you had a truly cashless society, and imagine you've got a world where everything, your cell phone has an RFID chip in it or anything, you can just swipe it and use your thumbprint to authenticate yourself and pay for anything instantaneously online with this system. It probably has credit integrated with it too, so you can, pay with borrowed money if you want to, and it's all integrated. Sounds really cool. Well, what happens when the power's out and the thing's not working and there is no cash anymore? So there has to be cash, at least small amounts of cash, just so you can deal with situations where you're offline, you're not in, there's no Wi-Fi. What do you do on a boat to pay for, you're on a cruise someplace and you're out of range of internet connectivity? How do you pay for a beer? There has to be some kind of cash. How does that get resolved? That's got to be part of this. I think that it has a lot of complexities, and the other thing is that no matter how hack-proof anything supposedly is. I was a hacker when I was in high school. It's a question of just the hackers figuring out a way to think outside the box and figure out a way to do something that couldn't be done before. Cryptocurrencies do rely on encryption to some extent. Quantum computing potentially has the ability in coming years to just orders of magnitude change in how long it takes to factor a key. And this is a computer science thing, but when you have all these big encrypted systems, it's always possible to crack that code by a process called factoring, which is you figure out all of the prime numbers that eventually got multiplied together to come up with that encryption key. It's a very, very compute-centric cycle. So the way they design these things is say, okay, how long would it take the world's fastest computer to factor this key that we're designing? Well, 250 years. Okay, it's safe because we're going to expire the key every 20 minutes. So there's no possible way anybody could ever crack power back on basically to your cashless society system because they found a way to defeat it somehow. There's all kinds of risks. And what always happens, especially with governments, is they assume that based on current assumptions about available technology, about available computing horsepower, that it's going to be impossible to crack something. And what happens is, it's the old mistake of every generation of software engineers. There's no reason to accommodate more than 640K bytes of memory because it's impossible that anybody would ever want to write a program bigger than that. That was the limitation of MS-DOS. And of course, memory got cheaper. And all of a sudden, these days, 640K is nothing. But that was the big limitation for years and years because somebody made the assumption that nobody would ever want it. Somebody will make the assumption that, a key of a certain strength can never be cracked. And it won't be crackable for a while until it is. And then it will be. And then what happens? So there's all kinds of risk to this. But I think the biggest ones really are that we get to a point, and this is just my personal political view. Some people, certainly can have the opposite view, but it's the George Orwell prediction. I think that if you get to the point where the government can monitor all financial transactions of all people on the planet, that's a really, really bad thing, not a good thing. It doesn't make us safer. It makes the world more dangerous, not less dangerous. And, I'm not going to get into, a philosophical thing about my personal political beliefs. I know a lot of people feel the opposite way. I guess I'd say look at history.
I don't know. It's very interesting to me, and it's also very frightening at the same time. Like, I can see how things could very easily go wrong. But anyway, let's save the rest of that for another day. I mean, I'm sure we could very easily turn this into a 3-hour podcast. But Eric, it's been an absolute pleasure having you on the podcast. Now, I know you also have your own podcast, Macro Voices. If someone wants to tune into that podcast and check it out, where's the best place to go?
It's macrovoices.com is the website, or you can just put Macro Voices into iTunes and subscribe for free. Similar to your show, it's always free, and it's a different format. What I tend to focus on, you've got, well, actually, between Kevin Muir last week and me, maybe we're going to have a little macro takeover of Chat with Traders. But, where your heritage has been very focused on traders and technical analysis and so forth, my podcast is all about these longer term views and getting macro experts on the show. So it's macrovoices.com, or find us on iTunes, and it's a free subscription.
Okay, and you're also on Twitter as well. If someone wants to follow you, what's the best handle?
Sure. At Eric S. Townsend, ERIK, as in Scott, Townsend, TOWNSEND, or at Macro Voices, either one.
Very good. Cool, man. We'll have to do this again sometime, eh? I've really enjoyed it. Thank you.
I have too. I've very much enjoyed it. And, the things that I predict in terms of, what could happen, that's one scenario. I'm not necessarily saying that's going to happen. What I am predicting very strongly, though, is governments are not going to stand by and let the libertarian features of cryptocurrencies just blossom. There's going to be resistance. Exactly how it plays out, I don't know. Nobody knows. But it's going to be an arms race, and it's going to be very interesting to see what happens.
Have you done some episodes about this on your podcast?
We've talked, I think I probably talked more about it in this podcast than I have on my own podcast, which is interesting. I think it was the end, Pippa Malmgren, who's a fantastic interview if you want to do more macro stuff, had her on the program recently. She's a geopolitical analyst. She's been an advisor to several U.S. presidents. She brought up cryptocurrencies, and it was in the post-game segment after her interview that Patrick, my co-host, and I talked a bit about crypto. But I think that's the only time we covered it on the show.
Okay. Well, I'll dig up a link to that episode, and I'll make sure to include it in the show notes. So, yeah, once again, Eric, thank you very much for doing this.
My pleasure.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Every decade, the market reinvents itself. Online brokers opened the doors. Mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet strategies with
Calculation and risk. This is the Chat with...
But exactly on machine learning. His trading decisions are driven purely by data, and he goes to grow. This 142, and I have a little fun fact for you, and this was totally unintentional, I promise. But exactly 100 episodes
in Fifield.
Hey guys, what's good? Right now you're plugged into episode 142, and I have a little fun fact for you, and this was totally unintentional, I promise. But exactly 100 episodes ago, I had Bert Moeller on the podcast for episode 42. This week, 100 episodes on, he joins us once again. Bert is an algorithmic trader with a serious focus on machine learning. His trading decisions are driven purely by data, and he goes to great lengths to remove human flaws and human bias through the use of automation. So coming up over the next 60 minutes or so, you'll hear about Bert's increasing efforts to automate as many decisions as possible, the attraction of markets and areas with less sophisticated participants, other potential sources of edge beyond alpha, a peek into Bert's high-frequency market-making strategy, and that's certainly not all. Now, I thought I should just throw this in there, but I can understand if some of Bert's ideas might seem a little abstract at first to some listeners, but one thing I would really like to encourage is that you do listen through this episode with an open mind, because that's what I like about Bert, his willingness to think differently and get creative. And once you get to the end, if you have a question, you're welcome to post that question in the comments area on the website at chatwithtraders.com/142. And Bert will do his best to respond with an answer for you, which is nice of him to offer. Anyway, ladies and gents, for a second time, here is Bert Moeller. Bert, good to be speaking with you, man. You were first on the podcast. I think it was October 2015. Let me ask, how have you been? How's things tracking?
Absolutely super. Everything's been going really well. Been applying the same stuff we talked about back then. Learned many, many new things as well. And yeah.
And whereabouts are you living these days? I know you've sort of been bouncing back and forward between San Francisco and Russia and probably a couple other places. Whereabouts are you mainly set up now?
In SF right now. Just kind of focusing my time over here because there's so many opportunities. Just in general, in the trading world and, and blockchain world. And actually a lot of different markets opening up. I think there's a couple of things in the world going on that are kind of changing the fabric of reality, as I like to call it.
Yeah, I mean, if we have a bit of time at the end, I'd love to talk to you about some of those things. But to start with, let's focus in on your trading, most important. So, last time you were on, I think it was the first time we really kind of got into machine learning on the podcast. I think that was episode 42. So there's since been a few episodes where we've discussed machine learning at length as well. I want to ask, is machine learning still a key part of how you're developing your strategies today?
Absolutely. I think when we spoke last, I was still maybe, let's say, picking some instruments myself, picking maybe some features myself, doing certain stuff myself. I mean, it's either someone on my team or me doing it, but we've moved almost entirely away from any human decision making. The only thing that we decide is the kind of, if we're trading equities, the sector that we're trading maybe. So that we, don't end up randomly picking like 10 stocks that are all in the silver mining space.
So how do you even begin to do that type of thing?
You got to lay out your process. I mean, actually, the process is laid out for like a single ticker system in many books. There's different processes, obviously, but you just write down your process for alpha generation, then your process for money management, for everything, and you just see where you can automate, where you're making decisions as a human being, and which one of those steps you can remove from yourself, so the computer will do it instead.
So what's been the driving factor for wanting to remove as much human decision as possible? I mean, I understand it to a large extent, but why do you even want to remove the type of symbols that you're picking?
It's just because there's so much bias, and it's on a lot of it is on a completely subconscious level. I'm sure you had the experience where all of a sudden you learn a new word, right? And you start seeing it everywhere. And a lot of people would say that it's because you're now recognizing the familiar, right? But that stuff definitely exists, those kind of phenomena. And that kind of thing can, for example, today for the first time in the restaurant, they asked you what kind of ketchup you want, Heinz or something else. And you're like, shit, the word Heinz, the company name could just get stuck in the back of your mind. And when you're picking equities, maybe it seems random out of 60, but you saw the Heinz sticker, and you pick that. You don't know that that's not happening. And that's a bias. I mean, it could be bad or good in that sense. It's, the problem is, I was going to say, that it's maybe harmless, but in my experience, there's very few things that go wrong and are harmless. It's better to take something random than something biased. Does that make any sense?
It does, yeah. So ultimately, you're just trying to remove as much bias as possible, yeah?
Yeah, it's just no outside information. Because look, you're still a person, right? You're talking to different people. You're going out socializing, maybe not even with trading people. Give you an example. I was speaking to my mother recently, and Bitcoin was down, and she's like, "You have to buy it. It's gonna go up. You have to buy it. It's gonna go up. Don't be afraid. Just buy it. And I'm like, maybe it seems random out of 60, but you saw the Heinz sticker, and you pick that. You don't know that that's not happening. And that's a bias. I mean, it could be bad or good in that sense. It's, the problem is, I was going to say, that it's maybe harmless, but in my experience, there's very few things that go wrong and are harmless. It's better to take something random than something biased. Does that make any sense?
It does, yeah. So ultimately, you're just trying to remove as much.
Yeah, it's just no outside information. Because look, you're still a person, right? You're talking to different people. You're going out socializing, maybe not even with trading people. I give you an example. I was speaking to my mother recently, and Bitcoin was down, and she's like, "You have to buy it. It's gonna go up. You have to buy it. It's gonna go up. It's gonna. Don't be afraid. Just buy it. And I'm like, that's crazy. And obviously I sold it. But buy it, and I'm like, that's crazy, and obviously I sold it. But still,